we stole the show. At least we stole the show. At least we stole the show. Sold out, this is fading, but the band plays on now. We're crying, crying, so let the velvet roll down, down. No heroes, villains, one to blame, while wilted roses fill the stage, and the thrill is gone. Our debut was a masterpiece, our lines we read so perfectly, but the show, it can't go on. We used to have it all, but now's our curtain call, so hold for the applause, oh, 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 and wave out to the crowd, and take our final bow. Oh, it's our time to go, but at least we stole the show. At least we stole the show. At least we stole the show. At least we stole the show.
Ladies and gentlemen, please take your seats. The program will begin in 5 minutes.
Been getting tired of my motor running, feeling overheated 'cause my life keeps coming. My heart has been troubled by the street of love. Searching these streets for a soul committed, talking ideas on lust and pity. The fables I found have no place at home. Where I need you to want me, to help me, to tell me the truth. Say I need you to want me, to help me, looking at you from a freeway trailer. If you'd handled what I tell you.
Ladies and gentlemen, please take your seats. The program is about to begin.
Separate calls, no fine line, don't have to be a dead rat, 'cause dead rat can go wrong. But we could be friends. We could be friends. Put your head on my shoulders. I'm Francis. Still dreaming of a glory, something new. I can't remember what it's like to never want to let go. So good though we can be friends. We could be friends. Just put your hand on my shoulders. And I will stand for you.
Ladies and gentlemen, please take your seats. The program is about to begin.
Guess you gotta chase that ghost. Heard you bought some land in Mexico. And I said, way to go, man. 'Cause wherever you may roam, remember who there's a station playing rock and roll. So stay tuned in, stay tuned in. I will turn around for you.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
From the pickleball courts of Arizona
To the kabaddi tournaments in India.
to the cornhole boards at your local tailgate. This is what's next in sports.
Please welcome to the stage Bloomberg's Jason Kelly.
So I'm sure y'all are sitting there watching. It's like, we just saw this yesterday. Like, this guy, again, insists on showing the trailer. Anyway, we do have a new episode out today on Formula One, so please check that out. Hope you had a good lunch. Really excited to talk more sports for you. We had a great conversation, obviously, yesterday with Mark Lazary. This one's going to be, don't tell Mark Lazary, maybe even better. It's going to be amazing to get into the world of golf. Obviously, a lot happening there and into the world of athletes and business. So that's coming up in just a second. We should take a look, as we did yesterday, at what's happening in the markets if we can. See, you guys are making a really good choice being here because the markets are going up, or at least the major indices there are going up. What is down there? Oh, commodities, yeah. Well, you heard about that from Alex Steele. In any case, that's what's happening in the markets. Let's talk about some sports. A few housekeeping notes, as we talked about yesterday. If you're watching this virtually, hello again. If you have any issues, refresh your browser. There's a chat box that you can use if you have any more trouble. If you're here in the audience with us today, Wi-Fi information is right there on the back of your badges. We will be having, I believe, some polls, not for this session necessarily, but you can scan this QR code or for your browser, meet.ps/Bloomberg Invest. So let's get on with the show. Mark Patricof and Company founder, and Michelle Wie West. You've heard of her. She plays a little bit of golf. Come on up, guys. All right.
I'll go around this side.
Oh, you're going around. Great. Excellent. Hey, guys.
Make Michelle sit closer to you.
Yeah, thank you. First of all, amazing kicks. You're like outshining me in the sneaker game, which good for you. And I will point out, since we're talking sports, I wore my sneakers, much more casual when I was talking like Henry Kravis. This is, this is much more cash. We've got so much to talk about in the world of sports. Not surprisingly, we got to start with the obvious news. This will come as no surprise to you, Michelle. By the way, when that news broke, I got 18 text messages from people internally who are like, aren't you talking to Michelle this week? And Mark, you know more than a little about this as well. What is your reaction to the Live PGA announcement?
I mean, I was, as the rest of the golf world was, absolutely shocked yesterday. Was not expecting that. I thought it was like a spoof Twitter thing, and then all of a sudden I saw all the major networks post it. I was like, okay, wow, this is a real thing. I was absolutely shocked.
And so, from a player's perspective, what's your reaction to this? You know the game of golf better than anyone.
Yeah, I mean, I think, honestly, kind of having a day to process this, we just don't have the right amount of information to make a decision on it. I think, unfortunately, the news broke yesterday without any and all information being released. I think it's going to take the next couple of weeks, next couple of months to figure out how exactly this is going to play out. And so for right now, I'm shocked, and I really don't have any thoughts beyond that.
And so, Mark, you've been talking about this a little bit over the past few days. From a business perspective, advising a lot of athletes, what do you make of it?
You know, I said on some network yesterday, it's like James Carville said in 1992, it's the economy, stupid. I mean, in a way, it's pretty predictable, an outcome. I mean, I was as shocked, if not more so, yesterday. But if you think about what was going on between the lawsuits and the PGA having to increase purses, there was no viable way for the PGA to compete against that money, and there was no viable way from a golf perspective, I think, for Live to maintain and build a real audience. So it was inevitable, kind of like the USFL and NFL in the 80s. I think it's in a way disappointing because the players should have had the loudest voice and really didn't.
And just building on that, Michelle, I mean, the players' voice across sports has gotten louder. You've obviously been a part of that. What do you make of the fact that the players seem to be left out of the discussion? I mean, that much is pretty clear that the players were not included, at least in these negotiations.
Yeah, I mean, it seems like from the little that I know, just the stuff that I've seen on social media, it seems like there might have been a leak that might have happened, and it seemed like the tour decided to come out ahead and make the information. You know, and as a player perspective, I think that's completely wrong, especially in a decision that affects all players, whether you're on Live or the PGA Tour. It affects your livelihood, it affects your decisions that you need to make in your business and your personal life. And players needed, like Mark said, need to have the loudest voice. And it just, unfortunately, seemed like in this situation that wasn't the case.
I mean, I think Greg Norman's going to need to look for a new job. He might be lucky getting a caddy gig at a Grand Slam. You know, it's if you think about what's happened, and not to move away from men's golf, but if you think about women's golf and other sports where we are trying hard, just as people who want to see players and their earnings uplifted, to see something like this done, where it's really done in a boardroom and done without the consultation and kind of thought leadership that should come from the people who actually build the sport. So I like it when I see Tom Brady buying a piece of the Raiders, or Dwayne Wade when we helped him take his stake in the Jazz. I do want to see more of that because I think it makes the sport more authentic.
Yeah. And let's talk about that. I mean, that's a really nice transition to something that I think is at the heart of what both of you guys are doing. And Michelle, I want to start with you. This shift that we've seen from essentially, in blanket terms, from endorsement to ownership. You've been a big part of that. You've seen it happen. You've been on the leading edge of it. Why did that happen? And what does it look like in practice?
Yeah, I mean, I'm very fortunately, from a very young age, I was endorsed by major companies, and I'm so grateful for that. I think it's definitely been a different shift in mindset, as these coming years, like taking ownership instead of just taking money and endorsing it. And it just feels like when you feel really passionate about a product or a vision in a company, instead of asking for an endorsement, now the mindset is, can I invest in it? Can I be a part of it? Can I be a part owner? And I just think it's so important for more female athletes to get into that mindset, because you've heard of the term multi-generational wealth when it comes to male athletes for years and years. And you've seen a lot of male athletes like LeBron James and Tom Brady, like you were saying, taking ownership in the things that they believe in. And it's just so, I've just kind of been following the lead of Serena Williams, obviously my whole career, but more so in this side of the business as well. I mean, she's now talking about multi-generational wealth, doing things that sets up, her daughter's life and, being a role model and all that. So it's just something, obviously, I'm learning and I'm taking very small baby steps in, but it's something that I'm very conscious of now when new companies approach me. Is this something that I want to endorse? Is there something that I want to take ownership in? So the mindset has shifted, and it's been a lot of fun.
And so let's go a level down on that, Mark, because you see this across the board with so many people that you work for. What are the mechanics of it? How does it work? And has the other side essentially sort of gotten religion on this and in approaching athletes and saying, we do want to offer this opportunity?
Well, I think historically, I'll give you a quick anecdote. I got to know Rob Gronkowski about 5 years ago, and we were sitting in the green room of a television program, and he was telling me about his Monster energy drink deal. And how he was going to get $1 million out of it this year. And I said, great, how many cases of the Gronk Monster are you going to sell, or are they going to sell? He said, I don't know. I said, well, ask your manager. Text him, comes back with a number. I asked him what the retail cost of it is, wholesale cost. I gave him back the math about 10 minutes later, which was they made about $65 million and Rob made $1 million, which was part of the thinking for me around that's just not really right. I mean, it's not about ethics, it's about trying to provide people like Michelle or Rob, the resources and the access to being paid fairly for their value. So that's part of the thinking. The other part was, if you look at a Michelle Wie West or a Dwayne Wade or a Bryce Young, you name the athlete, their relevance, whether or not they're billionaires, is pretty similar. So I love Mark Lazary. I heard he dropped an F-bomb yesterday. I'm not going to do that. Mark kind of earned his way in the sports world through finance, and he has access to a lot of things now because he's a billionaire. The athletes that we work with have some of the same exact access, but not the same balance sheets. So the idea is, how do you put them in a position to take advantage of that access and to work together off the field the way some of them do on the field, team sports, and then get them into some of the same transactions that have created that wealth that a Lazary or a Buffett or whomever you might admire in the business world have done in their business lives. And that was the idea for our firm, but it's not unique to us in the sense that you don't need an advisor necessarily, but think about the general efficacy of an endorser versus that of an investor. If Michelle writes a $50,000 check into a company, her emotional connection is just going to be different than had they paid her $50,000 for 10 social media posts or whatever it may be. I'm sure she would have delivered what she promised in that contract, then on to the next thing. So the emotional connection and then the ability to lean into that investment is really enhancing value for some of these companies, and therefore the exit is better and they make more money.
And so, Michelle, how do you assess a deal? Like, what's the process you go through? What's the lens that you take when you're assessing a potential relationship?
Yeah, before working with Patrick Huff, it was just very simply, do I like it or not? Obviously, learning now, it's a lot more into it than that. And this is why, I've learned so much from Mark personally. It's just what to look for in a deal. For me, obviously, the most important thing is, do I believe in it? When I first created my portfolio, I invested a lot in women-owned companies, women of color, and companies that try to make a difference in the world, whether it's in climate or whether it's in reducing barriers into sport. So it was very mission-based for me. Obviously, I think I've started to expand beyond that and just doing some investments that make a lot of sense. But I always come back to the mission part of things, and that's what I get most passionate about.
And so let's talk about the women's side of professional sports, and we can start with the LPGA and then sort of move out from there, because I know you've taken a view on not just golf but others. Talk about the state of women's golf right now. There was a lot of excitement, over the past couple weeks with Rose doing what she was doing and drawing a lot of attention, and yet still, I looked and saw, I'm sure what you guys saw, which was it's hard to find. the site is not as good as it, like the access to information at a time when everybody was raving about how good, like the Masters app was. What needs to happen to elevate the game, in your estimation?
A lot.
Yeah.
I'm very proud with where the LPGA is right now. If you look at where we've came from, going back to the very beginning, 13 women came together and created the tour from nothing. They were everything. They were the marketing team. They were the rules committee. They did it themselves with $0. And to now, fast forward, we have, I think, over $100 million in purses this year. So if you see where we've come, I'm very proud. But to see where we need to go, we still have a lot of work to do. And I think some of the things that included in that, like you said, making it a lot more accessible for fans to get engaged with our tour. I think people get very excited about one-off events, like last week at Liberty National when Rose won. But it's also, okay, how do we upkeep that? We need to get people involved and also keep them there. And that's, to this day, technology. Like you said, the Masters have an app. The PGA Tour has a great app. They have ShotLink, the technology behind statistics. We do not have ShotLink on our tour. Our statistics, we just receive shots gained. And it's hard. It's hard because if we don't have these statistics, it's hard to make good television because these broadcasters, it's hard for them to argue why our players on the LPGA Tour are good because they can easily be like, oh, wow, player A and B have the best short game. You need data to back that up now. Consumers, viewers are not stupid anymore. You need numbers, you need statistics, so we need stats, we need better technology. It's a chicken and egg situation when people talk about the pay gap or why our purses are so much lower than the men. Well, people's first response is, well, there's less viewership, so you're not going to get TV. Well, if we aren't on prime time, if we aren't live, of course we're going to get less viewership. When you look at venues, we need to continue to be on iconic venues. Last week, we played at Liberty National, and that was huge. This year for the U.S. Open, we'll be playing at Pebble Beach. Viewers like to watch things that they recognize. This is why the Masters is one of the most highly watched sporting events every year, is because everyone that watches it knows exactly what Tiger did here, and here, going back to 1997. And we need to play on courses like that where people recognize and can compare our players to the men. So I think venues, TV, we have TV right now, but there needs to be more commitment and having more cameras on site, being on prime time. Stars. And that creates the stars, and that creates the stories. So yeah, I can go on and on about this, but I think those are a couple of the things.
Well, and it's interesting, too, because the data is starting to come out that really supports your point that if it gets on TV, I mean, a lot of what we talk about, and Mark Lazar was talking about this yesterday, you look at March Madness, women's and men's. 10 million people watch the women's final. About 14 million people watch the men's final. That's not that big of a gap. And it's largely because people were able to watch it. I mean, I know I'm preaching to the converted here. What do you see, Mark? I mean, you have a really wide lens across lots of sports. You represent and work with a lot of people. What do you see more broadly when it comes to women's sports and valuations and access, et cetera?
It's very tough. I mean, I started the business 4.5 years ago, and we struggled to find women athletes who had the intellect, the aptitude, the bank account, the interest in participating in what we were doing, and also, most importantly, because I could have had 20 WNBA players and NWSL players, we would have lowered minimums, all that kind of stuff. But the brands themselves, the companies in which we were investing, weren't interested in those big names. So I think it does start with the public acknowledging, wrapping their arms around. And certainly, a decade or two ago, when we had major, including American tennis superstars, it really moved women's tennis. And now, if you see where women's tennis is, CBC just put $150 million into the WTC. I think it's a complicated kind of combination of things that would lead to the kind of success that women's sports deserves. My brother started an all-women's sports league called Athletes Unlimited, and they're doing a pretty good job with lacrosse and basketball and softball and other sports. But at the end of the day, we kind of know the sports people gravitate towards, the major sports. Golf's one of them. So to me, it's kind of shocking that women's golf is so far behind in terms of the purses, in terms of the courses they're able to play on. and then ultimately in terms of the broadcast. So I think from my business perspective, the more Michelles we can work with, the better, obviously, for all those reasons. But I think it's our job just as part of the ecosystem to make sure that we don't forget women just because, a Joe Burrow is going to make $500 million on the field, and the next women's golf star, barring any change in the sport, might only make $20 or $30 million, but generate just the same value for the audience.
Right.
Not fair. So.
And Michelle, as you look at the landscape from an investor's perspective now and investing in women's sports, what do you see as the opportunities? Because there are a lot of variables that are going in, more viewership, higher valuations, compensation is still a big question. Can we get a water?
Smoke.
Yeah.
Switch questions.
Yeah. Anyway, I mean, on that topic of valuations, Mark, I mean, do you see that moving the needle? And are you seeing
Valuations of what? Of women's
Yes.
sports franchises?
Yeah.
I mean, first of all, sorry, everybody. I know you'd rather hear Michelle. She'll be back. I mean, we've looked at 2 NWSL teams in the last week. One is a franchise that came to us a year ago at a valuation that's about half of what they're asking for now. You saw those 2 new franchises that came in, including the owner, founder of 6th Street, paid $50 million for the Bay Area team.
Yeah.
So those franchises have gone from $5 million in value. I looked at the Gotham FC when I think I could have bought the whole thing from Phil Murphy for $5 million.
Yeah.
They couldn't afford to put the women in appropriate housing, and that was 5 years ago. Problem is the valuations are also tied to other parts of the business. So it's season tickets. Some markets great, Portland, Seattle, New York not so good, Philadelphia not so good. Broadcast, it's great to be on Peacock, but you have to actually have a broader audience. Stadium deals, Gotham has to rent their stadium. They don't have any relationship to the Red Bull Arena. So there are a lot of factors before you can get into valuation as a standalone question, but clearly, the NWSL, which is the only real the WNBA has been subsidized by the NBA and wealthy NBA owners. It's kind of hard to use that as a direct apples-to-apples comp. But I think women's soccer is one, and I think you are seeing the numbers go up. But they're going up, where an NWSL team might be worth $60 million today in a great market, a market that supports season ticket holders and has real sponsors. I'm not sure that it ever catches up to the $600 million value, which I think is ludicrous for some of the MLS teams.
Yeah. And so when you talk to athletes that you work with, what do you sort of generalize in terms of what the leagues are doing to support them? I mean, the conventional wisdom is that the NBA is probably the most supportive of its athletes. Maybe the NFL is a step or two
don't drug test
behind. What do you think in terms of, especially supporting them as business people? What do you see?
I think it's tough. I think they do mean well for the most part and talk a good game, but think about the ownership base across football, baseball, basketball, and hockey to a lesser extent. These are old guard owners, most of them in their 70s and 80s, set in their ways, making a lot of money off the increase in value of their teams. I think there is an element of just keep the players where they are and let them do what they do, and we'll cycle through them. And if it's not XYZ player, it'll be the next one next year. I don't think the leagues have done much. Certainly some stuff on the surface. And by the way, the only reason my business exists is because the wealth management community and the agent community really wasn't interested in getting anywhere near the 20% or so of someone's net worth, professional athlete's net worth, they wanted to put into alternative investments, and therefore they were going in some cases, into very foolish things, getting burned, and then being blamed for not being smart, which of course is not the case. It's just, you lean on what's available to you, and they should be investing their money. So I think the leagues are aware of this. They've tried. I think they've done a good job of making sure the wealth managers aren't stealing from the players. For example, the NBA has had their tech summit. So there are things going on. But I think until the ownership really turns over and modernizes, which you've seen more, by the way, in the NBA than you have in the NFL, for example.
Right.
Therefore, not a surprise that they're a little bit ahead.
Well, that's what I wonder. I mean, that would be sort of it feels causal, right? I mean, that you have a lot of people. I mean, again, I keep going back to Mark Lazarus because he was sitting right where you were sitting yesterday. But, he took a very different approach because of, sort of where he came from, what he saw, and then you sort of go down the list. You have Mark Lazary and obviously Wes Edens. You have Tony Ressler in
Ryan
Atlanta.
Smith,
You have
Tepper.
Ryan Smith. You have Tepper. You have like all of these folks who've really, they bring a different perspective. They bring a perspective more like yours, candidly.
It's also not meant to be, I think, for most of them, the first line in their obituaries. So if they can invest, make $300, $400, $500, $600 million, $1 billion, win a championship, maybe like Mark did, and then exit. What better than that? Do you really need to hold on to that asset and pass off to your kids? First of all, most of the owners who are passing these assets off to their kids, the estate taxes won't cover the liquidity threshold they need to have. So these teams may have to sell because you don't have owners like that. So I think that is, again, not so dissimilar from PIF buying into golf or Silver Lake buying to Manchester United. Institutional capital. There are no billionaires left, or not enough billionaires left, who want to have the headache of owning these teams to do that.
And so, Michelle, would you ever consider team ownership? Is that something you've thought about? How do you suss that out?
For sure. I looked into NWSL. It's something that I would love to do. Me and my husband, that's something that we would absolutely love to do, especially in women's sports, especially, the new excitement into women's sports. I would love to be a part of that.
Or golf. You could own the future of golf. I'm serious.
That'd be fun.
You got to think about it that way.
I wouldn't mind that.
Yeah. What do you write the check for? Who do you write the check to for the future of golf?
That will build PGA or PGA adjacent. You never know.
And so
LPGA meant.
Yeah. And so what does, we talked a little bit about this before, but the growth of golf has been really interesting to watch over the past couple of years. It got a bit of a pandemic bump. Now it's got its own drive to survive, at least on the men's side. What does the game of golf need to do? And this goes back a little bit to where we started, because some of those innovations, the shorter rounds, the no cuts, all of those things, what does golf need to do to continue to be popular?
Yeah, I think it needs to be easier. In my opinion, I think it needs to be shorter. Kind of, if you think about what pickleball has done to tennis, I think there needs to be kind of that version to golf. It's just the barriers into the game, unfortunately, are really high. It's expensive. It's really it's a big time commitment. And a lot of times, a lot of rules when it comes to fashion and how you look. So if you see what pickleball did to tennis, obviously it made a shorter court of wiffle ball, a lot easier. I would love to see that happen more in golf. I think it already has started to happen. You see Topgolf, you see Pop Stroke, you see the new venture that Tiger and Rory started when it comes to esports. And I think those are the right direction the sport is taking, but when it actually involves getting more juniors into the game, I think there needs to be more par 3 courses that are accessible with slightly bigger holes. There needs to be 12-hole courses. There needs to be a lot more public courses that are playable and more suitable to kids.
And so as you think over your journey, both as a player and as a business person, as an investor, you look at the landscape now, you've got NIL, you've got social media in a way that didn't exist in the same way when you were coming along. What's the advice that you give to the youth, to Rose or whoever is sort of coming in and following in your footsteps?
Yeah, I think the NIL landscape makes it so interesting. Rose made her pro debut last week, but in a sense, she was always pro, since she started her college career. She has big endorsements. She has sponsor obligations, which were also very new to me when I turned pro. But also, I'm very glad that I grew up in an age where there wasn't social media, because it's very difficult.
We all are, believe me.
Yeah. I remember getting my first cell phone when I was 16. So even before that, when I was playing in PGA tournaments, I'm just so glad that Twitter wasn't around.
Yeah.
But these new athletes that are coming up, they have it hard. They have it hard because growing up in the spotlight is one thing, but growing up with social media, it doesn't matter if you're a professional athlete or whatnot, but something that they're going to have to navigate. I don't really have any advice to give just because I didn't grow up in it, but even right now with social media, I would just say, just keep your head down and don't read anything about what's written about you.
And what business advice would you give, learning what you've learned, and not just with NIL, but even the idea of, how to sort of set your course?
Yeah, I would say, like Mark has advised me, instead of, like the Monster example, instead of just I think this is especially female athletes, we sometimes when an offer is given to us, we're just so grateful that an offer is given to us, that even if they give us a bare minimum, we're like, oh great, someone wants to talk to me kind of mentality, and that needs to change. We need to look at what is given to the men. We need to look at what is the fair price for it and fight for what we're worth, and also ask the question of, is there an equity play? Can I take ownership in it? And I think just a change in that mentality with younger athletes will go a long way.
Great place to end. Michelle Wie West, Mark Patricoff, thank you so much. Thank you, guys.
Please welcome to the stage Quantum Co-President Charles Baillie, Carlyle Partner and Infrastructure Group Chief Investment Officer Pooja Goyal, and Apollo Partner and Head of Sustainable Investing Olivia Wassenaar with Bloomberg's Alex Steele.
That works. Hi, everybody. It's really great to be here. Thank you all for being here as well. I'm really pumped for this. We're all energy transition nerds or general energy nerds, so we're super pumped to have this included in Bloomberg Invest. So this is my way in, right? How's the weather outside, guys? So I haven't been out seriously since about 6. Is it getting better?
A little.
A little. Okay. I was double masked and I could still taste ash in my mouth. And that's sort of the lead into, I was thinking about this all morning. Are we investing in the right stuff with the energy transition? Is it hydrogen? Is it wind and solar? Is it direct air capture? Should we be fighting actual climate right now and the changes that we're investing in right now when we have California wildfires coming to New York? So I just want to get your quick take on that point to kick it off. Olivia, do you want to kick that out for us?
Sure. I mean, I woke up this morning and my kids were asking me about this.
Yeah.
Like, Mommy, is this what's going on here? What's causing this? And I was telling them, it's getting warmer and it's drier, and these things, can from time to time lead to the types of events that we're having. And I got into the office and I did start thinking about the same thing on my end. Like, are there investment opportunities that we should be looking at outside of what we've already done that really allow us to get at some of these themes? So climate change adaptation, for example, is that something that we should be spending more time thinking about? So I do think that there are other areas beyond what most of us look at today that could potentially be interesting.
Pooja, what do you think?
I think that you also bring up a very important risk management question, because how do you think about risk to your businesses as a result of what's happening in the environment right now? Today we're talking about air quality. It could be floods, it could be storms, it could be anything like that. So when investors focus on investing in the energy transition, it's not just about the commercial opportunity. It's also about making sure that your businesses are resilient to these kind of changes. The one thing I will say is that there can be a tendency to be reactive, where you say, we need to do something right now. And I always like to bring in a dose of reality when we're talking about the energy transition. So at Carlyle, we've not been reactive. We've been very intentional. We've been very committed to investing in the energy markets. And so it's important to think about this in a strategic manner, and how can you make these investments over the next 5 to 10 years so that you can mitigate the impact of days such as today or yesterday.
I should point out that all these guys have been in this business for 20 plus years, investing in this area. This is not like we just switched when it was cool. Charles, what about you?
I would say that the biggest issue in my mind is we think of this as sort of a local issue. So New York all of a sudden gets hit by bad air quality and everyone says, my gosh, we've got to do something about this. But the fact of the matter is, if we look at where most of the carbon emissions are coming from, it's just under two-thirds are coming from Asia right now. So the U.S. has actually brought down carbon emissions by a pretty substantial amount. They're rising dramatically in places like China, like India. And so I say to myself, how can we fix that problem? And at the end of the day, I really think what we need to do is come up with some technologies that can transfer quickly around the globe, that can help us solve not just the transportation issue, which is sort of 25% of carbon emissions, but the steel, the cement, the fertilizer, the plastics, the agriculture, that together is another 50% of emissions. We've got to solve those problems. I don't think we have any obvious way to do that now, and I think venture capital is probably the way that we're going to come to achieve that.
He does venture capital, by the way, because we weren't clear. We'll get to more in a second. But Olivia, you mentioned to me before we got on that you do have a water investment, unrelated to what's happening today, but you have invested in water. What was the reason behind that?
So our investment mandate, so we look at many things across the platform, across the broader ecosystem. For us, we've looked at a lot of things around what we talk about as the clean transition. It's happening in the energy sector, but it's also happening in lots of other parts of the value chain as well. So for us, water is one of the many variables that we've thought is interesting, and there's frankly probably more for folks like us to do in the area.
Does that mean like to clean the water, or we need to use the water to do the other things?
This particular investment is focused on making water more efficient.
Got it. Okay, to that point, I'd love to know from each of you if energy transition is the right phrase we should be using, and if there's a different phrase that you guys use internally. Pooja, you want to go?
That question brings a smile to my face because I think every investor you talk to approaches the energy transition in a different way. And so as an investment firm, for us, talking to investors globally, we need to meet investors where they are. So I'll just tell you how we think about the energy transition at Carlyle. We think that in order to invest in the energy transition, you need to cover the entire spectrum of the energy market. So that includes covering not only that barrel of oil, but also covering that electron, and also in today's market, covering that molecule of green hydrogen or green ammonia. But the philosophy that we have taken around the energy transition is invest, not divest. And what that basically means is that, yes, you need to invest in clean energy sources, but you cannot simply say that you're going to divest out of existing carbon-intensive investments. Divesting out of a carbon-intensive investment is just a portfolio construction or portfolio allocation issue. It doesn't actually eliminate a single molecule of carbon from the atmosphere. And we actually think that's an undervalued potential because you have a lot of existing companies as well as assets that can generate some really interesting returns while you work with those teams and decarbonize them over time. So that's how we approach the energy transition.
Who wants to pick up after that? Olivia?
Yeah, I mean, I'd say we approach it in a couple ways. I think the first is, again, really looking across the platform. We've taken a multi-asset class, cross-platform approach to doing this, whether it's on the credit side, the infrastructure side, the real estate side, the private equity side. We look at all different facets of our business and, what is the right risk return profile for all these different pools of capital. And again, we've really invested in all different asset classes, all different parts of the sector. I agree. I mean, I think understanding how hydrocarbons move, how molecules move, those are all really important components of understanding really the broader ecosystem we're investing in.
Charles?
To your specific question of energy transition, I think that is the right way to describe it, but I also think it's a very hopeful way to describe it. We've been talking about energy transition for the last 10 or 15 years. Mm-hmm. We've probably spent $10 or $15 trillion building out wind and solar and batteries, and we've done an incredible job of accelerating the growth of that. But when you step back and look at the facts, we've got, of total energy production in the world, solar, wind, and batteries represents 3 or 4%. 10% is still represented by people burning dung and other things. So I think what we have to realize is that transitions, if this is indeed going, we've never had a transition in the past. Hopefully this will be a transition, and we've got to think, to your first question, of ways to accelerate the transition beyond just, building solar, wind, and power, or solar, wind, and batteries to try to, right now, all it's doing is basically taking up that additional energy demand that's being created by the additional, couple billion people we're going to have over the next couple of years.
So we actually have a nice chart that shows the investment into different areas of the energy transition and sort of where it's gotten the most. And you know where it is, right? Like solar, for example, et cetera, wind. And now we're kind of transitioning to the new stuff. Charles does do oil and gas. We'll get to that in just one second. But Olivia, if you invested in oil and gas, would your LPs freak out?
No, in fact, we have discrete pools of capital at Apollo that continue to invest in oil and gas.
And that's okay, and you can do all, and you can feel like there's room for everyone to do all those things.
I think for different pools of capital, it is absolutely, something that we continue to do. And for us, we've really leaned into the transition. We've set some pretty big targets for ourselves in terms of capital deployed. And we're excited to continue to put capital in those areas as well.
And Pooja, for you?
Look, absolutely. I mean, we've been committed to the energy sector now for the last couple of decades, and we've been very intentional in that commitment, and we've not been reactive. I'll give you an example. We're invested in one of the largest privately held energy companies in Spain right now, Cepsa. We're invested alongside with Mubadala. Mubadala is a very important strategic investor with Carlyle. We've been invested in Cepsa now since 2019. And if you think about what Cepsa's core business is, it is a carbon-intensive business. They're very active in refining products and energy markets within Europe as well as globally. And what we have done is work hand in hand with the management team at Cepsa as well as Mubadala in order to implement a transition plan at the company. Not only are we reducing Scope 1 and Scope 2 emissions, potentially even Scope 3 emissions, but we have a strategic plan right now with Cepsa alongside with Mubadala, where by 2030, we expect more than 50% of their EBITDA to actually come from sustainable fuels. In addition to that, we're investing about 7 to 8 billion euros alongside with Mubadala in green hydrogen within Europe alongside with Cepsa. So again, these kind of decarbonization strategies that I'm talking about, these are not hypotheticals. These are things that we're doing within our existing portfolio companies, and we're very much going to do it with carbon-intensive energy companies as well.
Which is, to your point, not only do you want to decarbonize hard to decarbonize sectors like cement and steel, but talk a little bit about your specific oil and gas investments.
Sure. So we are one of the bigger investors, if you take all our portfolio companies and add them together, in oil and gas production in the U.S. We're also the third largest private developer of solar, wind, and batteries in the U.S. So we play both sides of the fence. And I wouldn't say, to me, it's an either or. Both will be used, I'm pretty confident, for the foreseeable future. And so in the solar, wind, and battery and other sort of ancillary services, you want to make sure that you're investing in the areas that you think will move the energy transition forward as quickly as possible. In oil and gas, we're in the midst of selling a $5 billion business right now. The only reason I think that we were able to sell it for the price we were able to sell it is because it was rated the lowest methane emissions gas company in all of the United States.
So you get the team, you get the assets, you get the business a little bit cleaner maybe or greener, and then you sell it. Are there a lot of buyers right now for something like that?
There are. We've sold $10 billion of assets over the last couple of years. If you look at U.S. government projections, we're using, sadly, just as much oil and gas today as we are in 2050. I believe there will continue to be a lot of buyers. Even if there aren't, prices are so, you had a chart up earlier, prices are so low right now in the oil and gas sector because there is very little capital available that you can buy businesses and basically make 3 to 4 times your money over 10 years and then shut down the business.
You guys all sound like you're on the same page. Is that really true, or are you all being nice?
We all were trained to Goldman, so I mean it's
well, yeah, I'm not going to touch that one, but okay, fair enough. Okay, then let's talk about returns for a second. Obviously, as private equity, you can't talk about specific returns, but I did have this chart up that shows, and I'm going to lean into it. Look at this. The S&P Global Oil Index is outpacing the Goldman Sachs Bloomberg Clean Energy Index, MSCI World, Bloomberg Electric Vehicle Index, and I appreciate that's cherry picking, like what the returns are in the public market, so I get that. But what do you say to people who are like, yeah, green stuff and energy transition doesn't give me the returns? Olivia, what do you say?
Yeah, I mean, I'd say the reason we're investing in the energy transition is because the returns are good, and we've seen good returns historically. So when we looked at the amount of capital we deployed over the last 5 years in this area, across our entire Apollo platform, it was about $23 billion. Those were done not in dedicated pools focusing on the energy transition. They were done finding good deals for our credit vehicles, finding good deals for our infrastructure vehicles, finding good deals for our real estate vehicles, our private equity vehicles. We were chasing returns the way we always do, trying to find great businesses, great return profiles for our investors. And a lot of these deals ended up in the area. So we see that, and not as with any asset class, not every investment is going to perform perfectly, but we've been very, very pleased with our return profile there.
Yeah, I mean, look, listen, I would agree with that. I think the commercial opportunity definitely exists. It depends on how you intend to target these kind of investments. If you look at the deals that we've done, almost all of our deals have been originated entirely on a proprietary basis. If you're going to bid the book and participate in competitive auctions, then yeah, maybe the returns are not really out there. But when we're talking about returns, again, I want to come back to the concept of the transition, because we're talking about returns not only associated with, let's say, renewable energy assets or storage assets or green ammonia, green hydrogen. I actually believe that there is an underutilized or undervalued potential around existing carbon-intensive assets as well. It kind of goes back, Alex, to your question about residual value risk or stranded asset risk.
Did I say that? Because that sounds smart.
Well, you were talking about you were talking about whether there are buyers that exist for some of Charles's assets or not. And I would say that, look, you have the expertise within the management teams. They know how to operate in energy markets. They have the expertise around these large infrastructure projects. These assets are very attractive. They generate some good cash profiles, cash return profiles. How do you work with those assets to optimize them, to reduce their carbon footprint, to position them for an exit? And that's really where we think that we can make a difference, given the expertise that we have, having been an investor in this market for the last couple of decades.
And I'd agree wholeheartedly with Pooja. I think the interesting thing to think about when you think about oil and gas, you think about the cycle of what oil and gas companies do. And we're not so concerned about oil and gas. I think we're more concerned about the carbon that comes from the oil and gas. So gas is CH4. It's a carbon molecule and 4 hydrogen molecules. If you can pull it up, poke a little hole in the ground, pull it out, strip the carbon molecule away, put it down in the ground, and keep the 4 hydrogen molecules, you've created hydrogen. That's how 99% of hydrogen is created today. If you run a pipeline with natural gas in it, you could be putting hydrogen in there. You'd have to change the pipeline a bit. You could be putting carbon in there. You could be shuttling all sorts of things around. If you run a power plant today that burns 100% natural gas, you can probably throw in, I mean, they're building turbines today that can use up to 100% hydrogen. So there are a lot of things, that's sort of the brown to green strategy. There are a lot of things that you can do to help the transition along that takes advantage of the infrastructure that we've spent a century and a half building.
So you don't need shovel ready. You don't actually have to put a shovel in the ground necessarily.
No. I mean, you might have to upgrade your turbine.
You might need to at some point. But
yes.
Okay, well, that's interesting. Then I want to get to kind of location areas. We have another chart that shows sort of where the money is pouring most, and a lot of the money is pouring into China. So just, and kind of dovetail that with maybe something that you're really excited about right now, an investment. Like, what region holds the most opportunity, either on a valuation basis or the kind of technology, the kind of companies that are being created, and then what maybe is an idea you're most excited about, Olivia?
So from a regional perspective, I mean, listen, this is obviously a very global topic. We have primarily been focused on North America and Europe, and see just so many opportunities in those markets that we really have continued to focus there. From an opportunity perspective, I'd say a couple things. First of all, we've spent a lot of time around enabling services for many of these sectors. So whether it's on the battery side, on the wind side, on the hydrogen side, we really like that, especially for a private equity asset class. I'd say the other thing we're spending a lot of time around is thinking about the grid. How are we thinking about the grid? How are we using the grid differently than we used to? What are the things that we need to do to upgrade it over time? And all the opportunities to make returns in and around that.
What's your favorite part of that? Because you can go really far up the supply chain in that, yeah?
Yeah, I mean, we've spent a lot of time specifically around batteries and their role in all this. I think that we're in really early innings around battery storage and how we're using that. And so have had some really successful investments around that. And I think we'll continue to deploy capital there.
Pooja, what about you?
We have a global orientation. I mean, look, obviously, North America, specifically the United States, is top of mind for a lot of investors, given the passage of the Inflation Reduction Act. But even before that, I mean, look, we think Europe is a strategically important market. We're very active in Japan, in Australia, and then also in emerging markets, especially around carbon-intensive investments. I mean, our view is that you really need to do a fundamental analysis around the need around energy sources versus what the incumbent supply stack looks like. And then you find value. So, take Japan, for example. It's a strategically important market for Carlyle. We have an embedded private equity business that focuses only on Japan. So we've got local expertise, local boots on the ground. And it is a market that has very strong demand fundamentals for renewable energy post the Fukushima crisis of 2011. So we're invested in an independent power producer in Japan. They develop, build, own, and operate renewable energy projects in Japan. They're biomass projects as well as solar projects. So we really cast a wide net, and then we really originate opportunities globally.
So before I get to you, Charles, you guys would be more on the later stage of a cycle for a company as private equity. Is that true?
So we tend to have more of an asset-oriented investment strategy. So we tend to do less of the VC, clean tech stuff. We do make growth equity investments as well, but we tend to be very downside protected, asset-oriented investors.
And we are very focused on credit, on infrastructure, and on private equity. So we don't have, we have not been focused on growth or venture capital.
And where in the credit structure or something would be interesting?
Really throughout the credit structure.
Oh, interesting.
Yeah. We've got pools of capitals, investments, really sort of throughout that.
So Charles, VC. So are you early stage?
We are, well, we have a private equity business, but interestingly, in private equity, we will invest in teams that go build businesses. So I'd call it more growth capital. And then in venture capital, yes, we are early stage. And I would say, in terms of very interesting opportunities, on the private equity side of things, I think historically solar, wind, and batteries were a very interesting area to develop or to focus on. If you wanted private equity returns, you'd have to focus on the development phase, like the early phase, and then sell it before you had to pour a bunch of money. And I think it's harder today because obviously we've seen for the first time solar production's come down, solar price has gone up. And so we've got a confluence of events that make it a little harder to make money there. That's not saying you can't, but there are all sorts of ancillary services. We own a business called Blue Float that won 2 concessions in the Scott wind auction, the biggest sort of offshore wind auction in Scotland. And then we got to thinking, so how are we going to build these 1,000-foot tall windmills that we need to float out to the middle of the ocean? And obviously you can't build them in the middle of the country because you can't drive them along a road because you'll take out all the houses on either side. So you got to find a port. There are very few ports around. So we found a port that was being owned by McDermott, an old oil and gas group, that was being transformed into a residential sort of effort. And now we have a 340-acre port, which is bigger than any other port in Scotland, that we can rent out to different groups. We have to dredge it. We'll use the sand to create the platforms for the solar. There are a whole bunch of derricks or platforms out in the North Sea that need to be recycled, so we'll bring them in and recycle them. So that is incredibly exciting. And then very quickly, I would say on the grid, to me, perhaps the most exciting thing on the venture space is really, as you think about, we're going to have to we're trying to electrify everything. That's the way we're trying to deal with this whole issue. So if we are going to electrify things, then we have to expand our grid. But the hardest, you thought it was hard to build a gas pipeline. The last thing you can do is build the grid. It's impossible. We haven't built it since 1975 here, and we have the most messed up grid in this country because it's divided into all these 3 areas, and you can't transmit electricity between them. So the bottom line is, if you want to, if you say it's going to be difficult to invest in the grid, then what about businesses, we call them, virtual power plants, but that sit behind your meter, and they'd say, Alex, we will pay you some money to be able to turn down your heat or turn up your heat or turn on your air conditioner or turn on your dryer at 12 o'clock at night or use your generator or battery to send back when we need energy. I think that type of technology, which is developing quickly, is fascinating because it allows you to not have as much transmission and distribution capability.
Yeah, and there's since Charles teed it up, I have to mention it. So thank you, Charles. But on the infra side, we actually have an investment right here in New York City. It is a company that was founded in New York City. When we invested, there were 8 employees. Today, there are more than 30 employees. It's called 9 Dot Energy, and they have microgrids around New York City. So it's exactly what you're talking about. They provide grid stabilization services to Con Edison. So we've got projects in the Bronx, in Staten Island, in Brooklyn, and that's exactly what they do. And I think, Alex, what's relevant there is that there are second, third order derivative opportunities that are opening up that are actually quite exciting. And not all of them are going to be billion-dollar plus deals. So, having those flexible pools of capital where you can do maybe smaller deals, maybe you can do growth equity, or maybe you can do, more creative structures can go a long way.
Well, this actually goes to my last question. We only have 3 minutes left. But as I mentioned earlier, you guys have been in this industry for a very long time. This is not like a new industry for you guys when it got trendy elsewhere. And so I'm really interested is like the one thing that's changed the most, say, in 20 years, that's changed either the way you invest or how you look at it or how you deploy the capital. Olivia?
Oh gosh, I mean, I remember the first deals I worked on when I got into private equity was a large solar business in Europe. And we had so many unknowns at that moment in time. We didn't know how long these panels would last. We didn't know what their efficiency was. We didn't know how we'd tilt them. There were we didn't know how to clean them. There were so many things we didn't know about. And so, you were able to see private equity rates of return on those businesses. Well, obviously, over, the last multiple decades, things have developed in a way that we now understand that. And so that's a different return profile than it used to be. We have businesses now that are where, solar was, 15, 20 years ago, that we are very much, looking at today. So I do think it's nice to see some of these technologies that are truly more venture growth now develop over time to become really regular way mainstream, and there'll be another wave of those things. We may look back in 10, 15 years and say, gosh, we understand everything about the battery, or we understand everything about hydrogen, and the return profiles may have shifted on those. So it is very much an ever-evolving space.
Charles?
I think my biggest learning is that there is no silver bullet. I mean, 20 years ago, we were talking about biofuels, and now we have 60 million acres in the U.S. allocated to growing corn and soybeans to create biofuels, and that hasn't solved the problem. I mean, I think as we think through the energy transition, it's going to take a lot of things, including all of us sacrificing, like maybe not living in 5,000 square foot homes or driving big SUVs. I mean, there are just a bunch of things that we could do today to really help the world, and I'm not sure, we're looking at it from a very New York-centric or U.S.-centric point of view, and we're not thinking about the things that we could do individually, I think, as much as we could to help this change occur.
It's always like not in my backyard kind of thing. Yeah, for sure.
I guess what I would say is that, renewables, energy transition, green economy, it's always been niche-y.
Yes.
And, I remember even from my days at Goldman getting excited about a 20 megawatt project and my investment committee telling me, please don't come to us if it's not 500 megawatts. But I think for the first time in a long, long time, what I'm noticing is a convergence between the traditional energy sector as well as the green economy. It might be happening for energy security reasons, maybe not just for climate change reasons, but guess what? It's a win-win on both, on energy security as well as climate change. So that is what is getting me excited, which is that if we can get both of these parts of the market to start working together, that could result in some really interesting opportunities.
Excellent. We just got to zero. Nice job. Thank you so much, you guys. I really enjoyed it. Thank you.
Thank you, Alex.
Taking an active approach to investing means looking at asset management through a different lens, one with a clear focus on our clients. Throughout market cycles, teams of specialists at Principal Asset Management have applied local insights and global perspectives to optimize results. This clear point of view allows us to identify the most compelling opportunities now, while positioning for what's next. Principal Asset Management, actively invested.
Please welcome to the stage former SEC Chairman and Sullivan and Cromwell Senior Policy Advisor and of Counsel Jay Clayton, and Pantera Capital founder and managing partner Dan Morehead with Bloomberg's Carol Masser.
Well, hello, everybody. We have a great duo here to talk about a lot of things. And I have to say, when I initially planned how I was going to do it, I was going to start with, crypto, because there's been a little bit going on. But I need to ask you, and I know Alex talked about it a little bit in the last session, about the weather and climate, because we're talking about stress in society. And I feel like the ultimate stress is potentially what's happening in our climate. And I feel like I'm seeing people wear masks again, people staying home, kids staying away from school. We're not going out of our offices. I mean, I've seen this movie before. So I am curious. Jay, let me start with you. Two super smart folks. Start with climate as a risk. How do you see it?
Well, it is a risk. And it's a risk that we've known about for some time. I mean, if you talk to property and casualty insurers, they've been modeling climate for years.
Right. Pulling out of California.
Exactly. But thinking about these things, and we can get into why they're pulling out of particular states and not others, which is not just climate risk, but I would say political and legislative risk. But what do today's events show us? This is a global issue. And we are unfortunately right now trying to tackle a lot of global issues with local regulation. Incredibly inefficient, likely ineffective. I mean, this is a Canadian-sourced, event. Right. Not a Canadian-sourced problem, but a Canadian-sourced event, manifesting itself here. Climate is obviously a global issue, it is not something, I'll just say it, it is not something that can be effectively regulated on a local and indirect level.
How big is it a risk to the investment environment? And then I'm going to bring you in, Dan.
Well, it's,
I mean, it already
is. But it's like other global risks. It's one that you have to deal with, right? Any type of geopolitical risk, which I think climate falls more into the space of geopolitical risk as to what we're doing about it. The idea that a business can somehow affect it is fanciful. The idea that a business has to deal with it is real.
Dan, come on in and how you see it.
Yes, the blockchain can be really effective when you have multiple counterparties trying to deal with each other in a central.
You went right for it.
No, I think blockchain can be effective because you need to know the provenance of energy credits, right? There's a huge desire to really cost out the impact of, as Jay said, it's all global, the contribution to energy or to climate change. And it'd be really amazing to have central credits where you can be trading those, where you know the actual provenance. Is it really a renewable source piece of energy that you're buying instead of just this, huge amount that gets dumped into the grid?
Do you think, though, in terms of the impact, I mean, here we are, we looked outside, it's a little bit better today, but are we giving it enough attention to realize we're going to talk about stresses, whether it's in banking, whether it's in crypto, as we saw certainly again another round this week. Are we giving it enough attention in terms of it as a stress point for investors and financial markets?
Oh, I would say not. I mean, yesterday was like a dystopian future, right? Like the Martian sun.
It's not an Apple TV series.
Yeah, no, that was pretty wild. Like, and people are hard with abstract things that are very slow moving, but yesterday was pretty hard to ignore.
Well, let me just pick up on what Dan said and look a little forward. If you're going to solve a global problem, you have to have coordination mechanisms. One of them is regulation, but another one of them is information and markets. We are not going to solve, if you believe that carbon reduction is an important part of managing climate risk, if you don't have a carbon transfer market, you have a very inefficient solution.
So you'll never get anywhere.
Well, yeah, it can't, there are a number of industries that cannot continue unless we have an effective carbon transfer market. I don't think anybody takes the other side of that.
I'm spending more time than I thought I would, but so based on some of the divisions that we're seeing right now, and you have US and China, biggest import in terms of the US, the global economy, but also major polluters. And I just wonder if we can't get those two together, can we solve it?
Well, they are together. I mean, no, they are together in a very deep economic way. When you have a stark, what I would say is a stark metaphor that Elon Musk uses with co-joined twins. But if you just think about it very analytically, what would the cost of an abrupt separation be economically? It's extreme. So we actually are together in this. One of the questions is, how do we go forward? I look at the last 20 years and that deep integration. We actually shifted dirty energy offshore to China. That's a big part of the integration. Now what do we do about it?
Right. That's not, yeah. Now we have to kind of figure out a better way in a big way. All right. Let's shift to crypto because I do want to get there. It's a shame we didn't have some news this week. How are we thinking about this? And our David Weston talked with SEC Chair Gary Gensler. He said he was questioning the actual value of crypto tokens. He also said the rules are already clear on cryptocurrencies. Dan, do you agree? I'm assuming no.
I think it's unclear because there wouldn't be these cases that are in courts if it were clear. If it's not yet clear what companies should do.
It's not yet clear what companies should do. Okay. But is it the beginning of the end?
Oh, I actually think it is the beginning of clarity. There have been some big events in our industry, like FTX's failure and alleged crimes last year, a bunch of failures of centralized lending entities, and then the recent cases against exchanges in our space. For better or worse, I think they will bring clarity. And I think that is great because blockchain is here to stay. The Federal Reserve's building a blockchain. China already has a couple 100 million people using a blockchain. It's a very important technology. The U.S. actually has a real national security interest in having blockchain happen in the U.S. versus offshore. So it might not be pretty, but it's probably going to bring some clarity soon.
Jay, how do you see it? Do you agree with Secretary Gensler's moves? If you were SEC chair, would you have taken these moves?
Look, it's his leadership now. He's been in this position for over 2 years. Where they've gone with this, I'm not going to be the person who throws bombs or second guesses from the sidelines. I am a supporter of the agency. I'm a supporter of the law the way it is. I think that when I was there, people would say I was a crypto hawk. We effectively shut down the ICO craze. Said that most of what I'm seeing is securities activity. But I do think we are having very blunt conversations about something that requires nuance. Crypto is really a technology. The use of blockchain technology in all sorts of aspects of our financial system should be not controversial. If you have an asset, pick a CMBS security, represented in tokenized form,
right,
there ought to be a way to custody that, transfer it, because it's probably going to be more efficient than what we're doing today. So there is a crypto use case that is clear, uncontroversial. We ought to be thinking about how to do that. I am remarkably impressed by the functionality of true stable coins, not the algorithmic stable coin, not the liquidity transformation stable coin, but a true backed by the same thing that we back bank accounts by. Okay, let's just put it that way, or backed by the same thing that you would back a repo by, something like that. A true stable coin, a remarkable technology at the retail level to be able to transfer dollars around the world. I mean, we use $100 bills in cash for a lot of things. I say we, not the populace, but people outside the United States. Wouldn't a stable coin be a better way to do that? Wouldn't it be better for KYC? Wouldn't it be better for AML? I think so. I think we ought to be looking at that technology.
I would say the irony is the only time one of the best stable coins, USDC, broke the buck is when it was announced they were a customer of Silicon Valley Bank. It traded from $1 down to 87 cents. And then when everyone realized it was completely collateralized, all that, it came back up to par. So I agree. Stablecoins are very important.
So what's the way forward, Dan, in terms of, as Secretary Gensler and the SEC obviously pursuing their moves against Coinbase and Binance? I mean, first of all, regulators behind? I mean, where should they have been maybe a few years ago?
Well, an important point, just like climate, blockchain is a global, borderless thing. It exists, and so regulators do need to think about it in a global context, not national, or even in the U.S. There's 8 or so different agencies that have purview. And the thing to remember is most countries are pretty neutral on blockchain, and even most agencies in the U.S., the CFTC, OCC, a lot of agencies have been very progressive, very far ahead of the curve. And so, globally speaking, regulation has been fairly neutral, and blockchain is now used by 300 or 400 million people.
Yeah, let me make a point on the cases. The allegations in the cases, again, in FTX and in Binance, it's reprehensible behavior. Okay? Nobody wants it in our financial system. But it's not on the blockchain. It's commingling. It's fraudulent representations to the extent true or not. It's not as if the technology failed or the technology had some sort of fundamental problem.
So then how do you think of the role of crypto and blockchain? And I know we kind of lump a lot of stuff together, but how do you think about it, Jay, going forward? So it's not going away, and the U.S. is not going to not have a role in it.
What do we know? We know that it's unlikely, blockchain is unlikely to be going away. We do need to update our technology stack in the financial system.
Right.
No one disagrees with that. It's not going away. What's also not going away is rigorous regulation of retail investment products. That's not going away. Those two things have to be reconciled. And that's where we stand today. And they're being reconciled in the courts, being reconciled in other places. But I think the blunt approach that blockchain, crypto is somehow bad is wrong. And the blunt approach that our traditional regulatory framework is somehow completely overbroad is also wrong.
Because some of the reporting that we've done, or in the last week or so, or just this week, is this thinking that as the SEC is widening its pursuit of crypto pretty aggressively, that the U.S. is ultimately turning its back and won't have a role globally. Do you see it that way? Dan, do you see it that way?
Well, I think it is a risk, because if you think about the internet, literally, the government literally built DARPANet, the internet in the U.S., and all of the major internet companies are based in the United States or a Chinese version of them. And so I think as an American citizen, that's great, you know, that it accrues to our country. Blockchain really is the polar opposite, that regulation in the US has been scary enough that 19 out of the top 20 protocols are outside the United States. And at a time last year, 95% of all trading of crypto assets was offshore of the United States. And, you know, again, I think there's definitely some bad actors, like Jay said, that really need to be criminally prosecuted. But most people are using crypto for very legitimate, very, very important reasons. And it's better to have it happen in the United States. So I'd love to see that flip where we prioritize.
And we have a few data points recently that support what Dan is saying. Other governments are supporting blockchain-based issuances of sovereign debt. So they're saying, you know, and we all know that at the core of every financial system is the sovereign debt.
Right.
And if you're going to modernize, you're going to modernize your technology stack, starting with sovereign debt, repo, that type of thing, is a very effective way to do it. It's interesting that we're turning away from that when other countries are now turning back toward it.
I do wonder, too, what's interesting in terms of regulatory framework when it comes to new technology. We've all been spending, and a lot of folks here at Invest have talked about AI, the next level, generative, machine learning. How do you think about the SEC needs to think about new technology? Is it a case of new framework for new technology? Or is it a case of new technology has to adjust to old framework? Or is that what tripped us up with crypto, Jay?
I think what tripped us up with crypto was the belief that new technology would bend the regulatory framework, that the new technology in the financial world would do what the new technology did in the taxi cab world, where it broke down arcane regulation. But the point I make on this is the core of taxi cab regulation was passenger safety, or at least it was supposed to be. The Ubers, the Lyfts, they didn't really break down passenger safety. In fact, they went there. They were breaking down something else. I think a lot of what I would say is the early crypto, the ICO, was actually breaking down investor protection, very much so.
Right.
Can't do that.
So I am curious. I know you and I were at an event in Orlando yesterday, and you said to me your phone was ringing off the hook the day before because of the golf get-together between PGA Tour and Live Golf, and then, of course, the crypto news. And Dan, I'm assuming that your phone has been ringing off the hook because of the crypto news as well. What is it that people, is that a fair assumption? What was it that people wanted to know from you about the news this week?
Yeah, I mean, I guess people are trying to parse, you know, what is the ultimate intention of these regulatory actions. And I do think Jay's point is very, very important. There was some alleged criminal activity that is totally separate from blockchain itself. And so investors really do want to have more clarity before they're going to commit larger amounts of money to this space.
Did you see a pullback at all this week?
Oh, I think so. I mean, people are...
In your work specifically?
Yeah. Investors that we talk to are all, you know, essentially waiting to see where the dust settles. And there's definitely a lot of uncertainty in the market right now.
Jay, what were the calls for you? What you can share?
No, I think the common theme is what's the end state.
Yeah.
You know, obviously there's disagreements. There's disagreements around classification. There's disagreements around methods to get there. If we're going to have tokenized trading of things that are securities, which I think many of them are, things that are commodities, and things that are others. Let's just pick one. Tickets. How about Taylor Swift tickets? Okay?
Yeah.
Like a market that's really important.
Yeah.
Market that's really deep.
That's my daughter.
Right? It's as deep as many shows as she wants to play.
Right.
Like, are we going to regulate the trading of tickets to a Swift concert in the same way that we regulate securities? I don't think so. I'm sorry?
Why not? Somebody asked.
I don't. Let me ask you this: Do you think that for Taylor Swift's immense popularity, we should apply that to the rest of the ticket industry? So if I'm selling tickets to a 50-seat theater and trying to do it, that I've got to go through SEC compliance?
Well, maybe not 50, but 1,000.
Okay, now we're having a real conversation about where you draw those lines. It's an important conversation
Right.
And what I think Dan will tell you is, I mean, he's much more a proponent, or I shouldn't say much more a proponent, much more understands the power of blockchain technology. There's going to be a lot of things, and maybe it's Swift tickets, maybe it's what do you earn when you play video games? Something bucks.
Oh, what is it?
Yeah.
V-Bucks.
Yeah. What are the trading of fungible items that are not securities, not traditionally commodities? What's it going to look like in the future? It's a really good question.
All right, I want to shift a little bit because the clock is going really quick. On lending and banks, regional banks, obviously the other crisis. What was really interesting is that as regional bank stocks sold off, I saw crypto moving up. We all did. How are we supposed to think about, I think initially we thought about the crypto world, Dan, as kind of a disconnect, a way to hedge stuff that's going on in the rest of the market. Although we have seen some correlation as well between regular assets or traditional assets selling off in crypto. We certainly saw that last year. So how are you thinking about it?
Yeah, I think that crisis does kind of harbinger the future. If you think about it, banks are kind of like terribly designed stablecoins. Here, I'll pitch you an idea.
Do you agree? Do you agree, Jay?
I'll pitch you.
Look, banks.
Sorry, I didn't mean to.
No, banks serve an incredibly important function, and they have been the source of liquidity transformation throughout the growth of our economy.
Until private lending.
Well, but what have we seen?
Yeah.
Technology has enabled an evolution in credit creation, and we're in the middle of it. Banks are going to be here 10, 15, 20, 50 years from now. They're going to provide services. But the banking industry's dominance of credit formation, that's a thing of the past.
So let me pitch this as a stablecoin idea. I invest $15 million of capital in my stablecoin project, and then I go sell to the public $190 million of stablecoins. I take the proceeds and I buy $210 million worth of risky assets. I promise the stablecoin people incredible liquidity. With the smartphone, they can get their money back same day. Unlimited amount. I also, when asked, isn't 13-to-1 leverage kind of aggressive? I'm honest. I say, hey, if the risky assets go up, I'm keeping all the profits. If they go down, I'm going to stiff the taxpayer. That's what a bank is.
Look, I'll put my bank hat on. I think that's about as stark as you could do it, because that's why we have bank regulation. That's why we have, because we actually need liquidity transformation, in our society.
Do we need more bank regulation? Oh, go ahead, Dan.
Well, I was going to say, the stark reality of some of these regional banks is the U.S. government's on both sides of their balance sheet, right? It's all the deposits, and it's half their assets. So why is a bank getting paid to intermediate between two sides of the U.S. government?
I think that asset liability mix changes over time, right? I mean, it just happens to be treasuries at the moment. For lots of reasons. Look, here's another thing that I would say. Regulation changes slowly. It takes a long time. You have to identify a problem. You have to deal with it, or whether it's too much regulation, too little regulation, changing it takes a lot of time. Be very careful about regulating based on a short event in time. The rapid increase in interest rates that we have had is very unprecedented, following what you and I call a control-alt-delete in the economy,
right,
where we shut the economy down. If you're going to base the fundamental regulation of banks, looking back over the last 24 months, you're likely to get it wrong.
So you're saying we don't need more bank regulation?
I'm saying don't do it with that near-term bias. When you look at it, what's the objective of banking regulation? Safety, right? Prudential, for the prudential system, but also part of it is credit creation. Right? The safest bank is a bank that has to hold 1-to-1. Well, you don't create any credit.
How many people buy Dan's explanation of the banking system? How many are with Jay? More traditional. A lot of people didn't vote there.
Hey, I'm always traditional.
Dan
did wear a tie today.
He did wear.
I come from Wall Street.
You knew that there would be pictures. There would be pictures. I guess what I want to think about. We've only got about 4 minutes here. I mean, the way forward. Are we private lending benefited from the crisis in regional banks? Has been, or did you see an uptick?
I think it's just a fairly steady long-term trend for some of the reasons that Dan articulated, is that you have a better asset liability match in private lending. You're on the liability side. It's not a daily liquidity product. People have given you their money for a period of time.
Right.
You lend for a similar period of time with very limited leverage. I think what we've actually seen through some of these what I'll say is stresses in the system is that the private credit market facilitates stability during that. You're not selling your assets into those periods of instability.
So Dan, what's your thinking the longer term? I don't know. Do we think about a year from now? What's the discussion we're having potentially around blockchain and crypto? I get blockchain more than I get crypto. And I know they go hand in hand, but I kind of get that.
Yeah, I would say I definitely agree with Jay that things take decades. It's going to take a long time. But I think it is the future, that banks really are the past, that the Medici used a very new thing called double entry bookkeeping to create banks. And now we have distributed ledger technology. It's the future. And so that's where we're heading. And, we're going to have these wild, hyperbolic ups and downs. But like a year from now, it'll probably be back on its trend of Bitcoin as a proxy for industry goes up 2.5x a year on average for the last 12 years. So I think we'll keep resuming that trend.
We've lived in a year or a couple of years where I think there are things that just keep happening that we thought never would happen. Pandemic, you were in the administration during the pandemic, complete shutdown. Or you just think about even the last, couple of decades between the tech boom and bust, the financial crisis. What is kind of the black swan event that we should be keeping on our... Who would have thought we would have gone through this pandemic? Who would thought we would look outside our windows and it would be like a movie, a terrifying one? So Dan, let me ask you, what's the black swan event that you think, when we talk about stress points, that we should keep on our radar?
Yeah, I used to sit next to Nassim Taleb on the Wall Street trading floor a long time ago. Everybody...
How was that?
It was fun. He's a super bright guy. Everybody ignores black swans till one happens, and then everybody talks about the next shoe to drop. I would say the biggest surprise is we had massive shoes drop last year. It'll just be kind of nothing crazy happening. And if you had to make me say something, I would say regulatory clarity is the one thing nobody's expecting, and there are a few ways that could happen.
And that could be the black swan.
That could be the positive black swan that we're all waiting for the next huge bad shoe to drop. That could be the nice thing.
Nice flip on that. How about Jay?
No, I'm gonna agree with Dan that we have these positive and negative inflection points. We would not have. Frankly, I don't think we would have shut down the economy 30 years ago, because we didn't really shut down the economy. We went to a remote economy. Went to an economy where we relied extensively on technology and
we were able to, right?
We couldn't have done that, and the cost of the type of shutdown that we did, we would not have been able to bear for as long as we did. I think that's clear, right? Food wouldn't have gotten delivered.
Right.
None of the things that we rely on would have been able to happen. So, we have a lot of what I will say is positive black swan events. I still think the power of technology for productivity globally is underestimated, and it is the reason why so many macroeconomists continue to forecast ineffectively.
I have a million more questions, but we've run out of time, so we've got to run. Jay and Dan, thank you so much. Really appreciate it. Really appreciate it. Thank you, everybody. Go ahead. Oh, and I forgot to say, we're going to actually take a break. There is a break, guys. Go stretch your legs, but we do need you back, I think, at 3:05 p.m. sharp. Am I getting it right? Yes. Okay, so come on back, because there's more to come. Thank you.
looking back, the time is gone. We turn the page, the past is in the past. Why don't we stand up to a love we know will last? 'Cause if we don't start now, then we might not get the chance. Hide away the sunlight, finding you can be my sunshine. Trying to become one, I found it all in you. So just let me know we can go somewhere new. I don't need the sunlight. We can go somewhere new. I don't need the sunlight. We can go somewhere new. I don't need the sunlight. We can go somewhere new. I don't need the sunlight. We can go
Hey, Ben.
Yeah. Thank you for coming up.
Yeah, no problem, no problem.
And Prophet, how are you on? Or did you leave it? Well, great.
High enough.
Way too many minutes. I just want to check the time.
Sure.
Sure.
Tracy, what'd you eat for breakfast today?
I had a donut. It was really good.
Ben?
Guys, did you guys have the pudding downstairs?
Yeah. Hello, and welcome to another episode of the Odd Lots podcast.
Hello, and welcome to another episode of the Odd Lots podcast. The closer.
Hello, and welcome to another episode of the Odd Lots podcast. I'm Joe Weisenthal. Keep talking. Dash, why is it that you got into studying cryptocurrency?
Well, obviously I have a lot of money already, and I wanted more. And that seemed like the fastest way to get it.
Yeah, that's right.
That makes a lot of sense.
Is that close enough or not? Oh.
show you the ropes, kid. Show you the ropes. Got a bus and a trailer at my house, my house. I'll show you the ropes, kid. Show you the ropes. I bought 15 cases for my house, my house. All the furniture is in the garage. But that bug is playing in my house, my house. You got to set them up, kid. Set them up. You got to set them up. Yeah. You got to set them up. Yeah. You got to set them up. Set them up. Well, that funk is playing in my house, my house. I've waited 7 years and 15 days. There's every kid for miles in my house, my house. And the neighbors can't call the police. There's a fist fight brewing in my house, my house. Because the dogs can't get in the door. When that bug is playing in my house, my house. You got to set them up, kid. Or set them up. You gotta set them up. Yeah. Got to set them up. Yeah. You got to set them up. Or set them up. You got to set them up. Yeah. You got to set them up. Yeah. You got to set them up. Or set them up. Well, everybody's lined up in my house, my house. And Sarah's girlfriend is working the door. Got everybody's PA in my house, my house. All the robots they're sent from the bus. There's a freak out brewing in my house, my house. In the basement.
Ladies and gentlemen, please take your seats. The program will begin in 5 minutes.
You got to set them up, kid. Set them up. You got to set them up. Yeah. You got to set them up. Yeah. You got to set them up. Set them up. You got to set them up. Yeah. You got to set them up. Yeah. You got to set them up.
Ladies and gentlemen, please take your seats. The program is about to begin.
Have a heart, 16666, and I know the part. You are the river flow, and we can never know. We're just the weatherman, you make the wind blow. Keep thinking about every straight face, yes. Wonder what your boyfriend thinks about your braces. What about them? I'm all about them. 6 such straight A's, cut 'em in the bathroom. So this is it then, you're here to win then.
Ladies and gentlemen, please take your seats. The program is about to begin.
At Southern Company, we have a vision of an equitable future. We're committing $50 million to historically Black colleges and universities for scholarships, career development, and the new innovative Propel Center. To foster inclusion and success for all. Southern Company, building the future of energy.
Please welcome to the stage Bloomberg's Michelle Lynn.
Hi again. I'm Michelle Lynn Still, Global Head of Data Science and Insight at the Bloomberg Media Organization, and I'm back to conduct our final poll for the summit crafted by our participating sponsor, Southern Company. Southern Company is a leading energy provider serving 9 million residential and commercial customers across the Southeast and beyond through the family of companies. So as a reminder, whether you are with us in the room or at home, please participate in this poll. We want to hear from you. If you could take out your phones now. Oh, great, people have them out. Scan this QR code. To access the poll, scan the QR code, or you could type in meet.ps/BloombergInvest into your browser. So everybody, give you a minute. The icon is in the bottom right. Okay, so the final question Southern Company would like to ask you today is, blank is the primary driver of my sustainable investment focus. And the options are aligning to corporate/internal values, changing, evolving stakeholder expectations, long-term results, and then other/not applicable. So please cast your votes now. All right, we're still getting some results in. The question again, blank is the primary driver of my sustainable investment focus. Okay, let's have a look at the results. Okay, all right. So 57% say long-term results, 25% aligning to corporate/internal values, 11% changing/evolving stakeholder expectations, and then 7% other. Thank you all for participating in all the polls throughout the summit, and thank you to Southern Company for providing such amazing polling questions. Enjoy the rest of the summit.
Please welcome to the stage Art Intelligence Global Founding Partner Amy Capolazzo with Bloomberg's James Tarmy.
Well,
I am thrilled to be here with Amy Kaplowitz, who has just been introduced, which means that I don't have to do it, which means that we can jump right in. As a matter of brief housekeeping, when we're talking about the art market, generally speaking, we're talking about the 20th and 21st century artworks as opposed to much older pieces, so unless we specify otherwise. And so, Amy, it has been a weird month or two in the art market. We saw the major May auctions in New York maybe stumble, maybe take a nosedive. I don't know how you want to diagnose it. We're about to head into Art Basel, which is the biggest fair of the year. What is going on with the art market?
Well, I would categorize the May auctions as maybe patchy is a good word. Where
Patchy.
So there were some perfectly celebratory moments of things selling very well and the market coalescing and agreeing on an object and its greatness and the ultimate price. And then there were places where things that felt stable 6 months ago, a year ago, maybe softened and fell out a bit. I would say that happened mostly in areas where the where the auction houses over-expected bidding and over-expected the price, or in places where the markets were much more speculative for younger, more emerging contemporary artists.
So what does that mean for someone who is thinking about investing in art on the secondary level, thinking about it at a very, very high end, 2 million up? How should people understand what the state of the market is presently?
Well, honestly, you know, there's a lot of cash sitting on the sidelines, as with the larger market, and there is, you know, any kind of softening or dip really becomes an opportunity. So I do think there were some opportunities to be had if you could move quickly, if you knew how and where to look, if you were, you know, prepared to be active on a moment's notice where things were going a lot less than people had expected.
Well, let's focus on that for a second. Where were the opportunities? Were they in specific categories, specific artists, specific periods? What is the market overlooking right now?
Well, I would say that in general, the market has been very focused on a masterpiece category. And I think masterpieces are still masterpieces, and they are, you know, the premier icons of what people want. And those that have the cash still have the cash to buy them at nearly any price. Because the masterpiece is still a seller's market, not a buyer's market. So the seller has control of naming the price. In the more emerging categories, so sort of go from the very high to the very, you know, entry level emerging, that's been a highly speculative market. And the truth about the primary market or the newly secondary market of young artists who are still in the making in their reputations, art historically, et cetera, that is was really patchy. So, you know, yesterday's news of this one's going to be the next hot star and then seeing it crater was happening here and there for some of the emerging artists. In the middle, there's moments where you can get some beat up blue chip where things just feel off market, not as hot as we thought. We saw that a little bit with de Kooning. We saw it a little bit with Krasner. We saw it a bit with, you know, even markets that had been white hot, like the Hockney market. We saw a little bit of softening there, and there were some opportunities. So I would say focusing on that middle level, and in the art market, that's from say 2 to 10 or 2.
Right.
There were some real opportunities.
It's funny because one of the main things that we keep, or I keep hearing at least, is that art is too expensive. That there has been a built-up valuation of prices because people are buying with the expectation that they'll be able to sell for even more.
And for a long time, that's been the truth. So.
Are we seeing that subside a little bit?
Yeah, I mean, the place where that is the most acutely felt is really on the more speculative end of the marketplace. You know, if you buy a $2 million Liechtenstein or a $6 million de Kooning, or, you know, the chances are there's some volatility, like with any asset, but it's not magnificent. It's more about, is it a slow time in that market or a robust time in that market, et cetera. But the sort of testing ground for those artists and their marketplaces, those are well-worn grooves of deeply trafficked markets. You know, like they've been trading for a long time. There's volume and traction of trading at all times.
So in a sense, you're saying that if you kind of stick with the blue chip, you're not going to find too many surprises, and even if it's...
Well, what you want is a good 10% what you want is probably a good 10 to 20% opportunity on an asset that pretty much holds its value. You actually don't want a 70% off sale because maybe it will never return to its previous levels.
That's, I think, quite valuable. Okay. So, you know, obviously, you are dealing with some of the world's richest people who
Or those that spend the most on art.
Well,
maybe they're not the richest.
One assumes that the two go hand in hand, given that if you're liquid enough to spend $10 million on a painting, you've hopefully got an extra $10 million to spare. What are your clients saying? Are your clients in a spending mood? Are they in a selling mood? What's the attitude of people?
I would say most of my clients are more judicious about wanting to be in a buying mood, but being careful and thoughtful about what the right price is and what to get. So if 3 or 4 things were on their wish list and the market just has gotten away from them or it's felt too hardy and robust to compete, they now are looking closely and saying, okay, which, of our 4 or 5 on the wish list, which one should we narrow in on now because it might be our chance?
Is that different from years past?
I mean, you're always looking for the right piece in the wrong hands or the right moment to buy something that's a little off radar. So I would say that's generally the trend. There's just going to be more potential for that opportunity now.
Interesting. And in terms of geography, you have clients all over the world. Are certain areas more ascendant than others right now?
Well, from my own life experience of having lived through, the early, like 2008, 2009 marketplaces, there's always someone who has money, and there's always someone who wants something, and the question is what's the clear price, right? So there's plenty of Americans still very active in collecting, very thoughtful, very much focusing on what a good acquisition can be in a time when the market feels a little bit down. I would say Asia is very, very active, and that's certainly been my firm's experience since the beginning of the year. I would say Europe is a bit quieter, but maybe just a bit more steady and not necessarily reaching at the highest levels.
So, I mean, I think for people in this room, people who are watching, thinking about maybe either staying on the sidelines or entering into the market, how would you advise people actually begin to approach what people are offering right now? Particularly as Basel.
Yeah, I mean, I think first of all, everything's just a bit slower, so you can ask a lot more questions now, which is really great, because sometimes Basel, the art fair can feel very fast and furious, and there's crowds everywhere, and if you're looking at something really good, you feel like there's someone right behind you ready to buy it if you're not. So I think it's a time where you can slow it down a little and ask a lot more questions. Like, where does this particular example rank within the artist's oeuvre? Like, what can you show me comparables? Can you show me comparables art historically and then comparables that have traded recently? So I might get a sense of value. I think it's a good time to be able to ask and do just a little bit more due diligence rather than use the pressure of the common pool of others who want it as your form of due diligence that it's a legitimate thing.
Well, and of course, well, maybe not of course, but when that pressure dissipates a little bit, you're going to see, or historically we have seen, a variety of artist markets really disintegrate. Do you foresee that happening when that, let's call it hype, is depressurized?
I mean, I often, first of all, I want to preface this by saying I love young artists, and I have, I visit a lot of artist studios and follow very young artists, both from, out of personal passion and from my own collecting a bit. But I always tell young artists, look, go slowly. Like, you could be a one-hit wonder, as they'd say in the music business, real fast. So take it slow, focus on the work, make sure the work is great. Don't put anything out there you wouldn't be proud of 10 years from now. Just really take it slow. I think there's been such hype and expectation around the primary market that that's arguably the most dangerous and speculative market to be playing in. So that's the one to really watch. And when those artists who can't survive the glare fall out of favor, it's usually permanent. So
right.
You just don't really want to burn out at 30 or 32. It'd be a lot nicer to make it further, right? As a
words to live by.
Yes, exactly.
For all of us.
Right. So I do think that's important. But some artists just don't survive the glare, and there's only a handful of artists in a decade that are ever memorable for that time that they came of age.
It's interesting that you say this, because we are in a moment where it feels to me, certainly, that there are more art fairs dealing with primary market works than ever before. How do you reconcile those two things?
Well, someone smart one time made a comparison to sort of animals during like long winters, and they say everyone has to go deeper in the forest to be fed. So that means dealers need more and more inventory, and the greatest place to get it is in places where it's plentiful and available, even if you don't know if it's nutritious food yet. You sort of go for it and see if it's if it'll work out. Supply side constraints on the more classical side of the market have been tough for dealers.
Right. That's interesting because that is exactly what I wanted to transition to, which is this sense that there might be a constrained supply of this kind of more blue chip material that you're talking about people investing in. It seems like estates are not necessarily coming onto the market quite as much. Is that wrong?
Yeah, no, I mean, I think estates, you're dealing with, for the last 20 years, the market has been fed by estates that contain impressionist and modern works of art, works from the late 19th century and earlier part of the 20th century. And that the age of the person who was collecting that is now, 90s plus sort of thing. And you're getting the second generation of contemporary buyers. So meaning they started collecting seriously in the 60s, let's say 50s or 60s. Now you're in the second generation of that where their estates are coming due. And we have, we see lots of things happening, like a little bit more clever tax planning, ways of understanding that this is actually a significant part of their net worth versus what it was, say, 20 years ago, where maybe it wasn't quite at the level it is today. So there's been much more sophisticated tax planning. There's always various trusts that can hold art for indefinite periods of time.
And so all of that is basically holding back the supply that we would...
Holding back supply. There's also, I think, an increased interest in collecting, so even the next generation might want a little bit of their parents' art, whereas before there was a sense that that was their parents' stuff and they would go get their own stuff. But now when the stuff's really good, you just want it. I think also you see the competition very fierce between the auction houses, and that leaves dealers sometimes a little bit less in play for competing for big estates, simply because it's become a very capital-intensive commitment.
And so are all of these factors making these kind of blue chip contemporary modern works more expensive, or is it actually because there isn't enough coming onto the market, does that sort of suppress demand because not enough people can want it and get excited about it?
Well, there is enough volume to, I mean, it's not like there's, I always say the monster stops wanting, if you stop, like the monster stops wanting what it can't be fed, it'll find something else to eat. So markets that are down to a trickle, like there's so little inventory available by those artists, people just stop wanting it and go on to something else when something's too scarce. But, estates in general, like of high quality material, things that have been locked in collections for 30 years, this is all very, very desirable. So the competition of the trade to get access to it, to sell it, and of course make commissions, et cetera, is heightened, which in some way heightens the overall desire for it.
So we're getting short on time. I think what a lot of people might want to know is, what do you see within the art market currently as a growth area? Is there something that, if we're looking at this from a sort of value investing standpoint, what do you see with real potential? Is it, whether it's an artist or it's a period or medium?
I would say, we've lived in a very American moment for a long time. Now we're going to see like certain parts of the world that didn't get as much attention for their art historical masters. For example, we had a big, revolution of Japanese works that were made in the 50s with Shiraga, Motonaga, et cetera. You're going to see some of that. You're going to see artists who are overlooked, women, artists of color still play a role, though the pendulum will swing back a bit, and you'll start to see the tried and true members of the art historical canon come back, who've been a little bit less hot because women and artists of color have gotten a lot of light. There'll be a little bit more sharing of the pie in that group a bit, but that will come back a bit more. I think across geographies, across underrepresented populations, and then even the old guard coming back in and looking like a good opportunity.
That's interesting. And do you see the same drivers, as in Americans really kind of dominating the market, with Europe and Asia sort of splitting the rest?
America and Asia will drive the market, and Europe will be a little part of that. But I see Europe as a little bit quieter for a while.
That's interesting, and I mean, potentially that also could be a buying opportunity for
yes.
for people who are interested in.
Europeans always collect. It's just where and what level. So.
Well, that is the key.
Yeah.
I see from the time clock that we have run out of time already. I could do this for hours. It has been really, really fascinating to hear your insights, and I'm thrilled to have you here.
Thank you. Thank you for having me.
Thank
Pleasure.
you for joining us.
Thank you.
Please welcome to the stage Union Square Ventures Managing Partner Rebecca Caden and Lux Capital General Partner Dina Shacker with Bloomberg's Caroline Hyde.
Happy afternoon where things don't look quite like it's Armageddon outside, you'll be pleased to know, in this darkened room, and that you have flown in. We are truly honoured to have Dina here on what is one of your last flying experiences before you have to settle down and just maybe stay in the same city. But it is so great to have East Coast, West Coast focus from both of you at such prominent venture capital firms. I sort of like the way it's called New Views on Venture Capital. Both of you have had a long history within building technology, investing in technology. But what the new thing, since at least November, is AI.
Yes.
So let's go there. Let's get this elephant out of the way. And Rebecca, from your perspective, you're a doomer, you're an optimist. How are you feeling about artificial intelligence?
I'm an optimist. I think I'm partly an optimist by trade and overall, but particularly here, I think the opportunities set to unlock and the efficiencies to create and the skills and abilities that we can't think of yet are going to outweigh the risks, which are there and are relevant, but are going to be manageable.
Okay, I like that they're manageable. Dina, do you have that same optimism that ultimately all the wringing of hands, worries about job implications, bias, will ultimately be outweighed by the positives in productivity and how it's going to help your particular area of expertise like healthcare?
Absolutely. I mean, we've been investing in AI for years, so certainly there is a lot that's new now. It does feel like a paradigm shift, but we were early investors in Hugging Face and Runway. In the healthcare space, we actually sit on a board together of a company called A-Life Health, which is using AI to transform fertility care. There is still so much more, and we're incredibly excited about the potential. Of course, notwithstanding the regulatory, environment that we're in right now, and making sure that everything is done safely and also without bias.
Go to regulation in a moment, but to the point of where AI is really disrupting, where's your brain space at? Is it more inbound, people wanting money, people calling themselves artificial intelligence companies who are trying to sort wheat from chaff? Or is it, how do I ensure the portfolio companies I have that aren't truly built on AI are ready for that disruption?
I mean, I think it's a little of both. Obviously, as a consumer, I love using it for bedtime stories for my kids and, recipes and so on. But as an investor, we're looking at what the really big platform shifts are going to be. And I think any tech company right now needs to take a really close and deep look at how they're using AI to make themselves more efficient, particularly in, frankly, in every field. But I would say when it comes to healthcare, there's so much opportunity, so much latency, so much bureaucracy. But it's a very different world when you're still talking about fax machines in the same sentence as ChatGPT.
Well said. And what about the fintech space, Rebecca? I know this is an area that you're particularly got some expertise in as well, across the board, as well as healthcare. Some have said maybe fintech isn't the first area of adoption for AI. What would you make of that?
I think that the incumbents across industries in healthcare and fintech and education have a big opportunity here, less because of their industry-specific nature, though there's some of that, and more that the idea that where there's rote tasks or efficiencies to be created by people, it can be a very powerful tool to create that. And that's cost savings, that's time savings, that's adding value into the stacks that's already there. And you asked about kind of existing companies versus new entrants. I think one of the unique things about this technology shift that's somewhat different than if you think about mobile is that the incumbents not only have distribution advantage, but they have data advantage that's very, very relevant, and that the technology is easier to use. So integrating it into existing platforms is a lot easier than in prior technology shifts, so they can do it faster, get up to speed, and use multiple advantages. And I think you're gonna see that now and for a while across industries that give these big players, a real opportunity if they can jump on it.
But then what does that leave for the startups? I mean, we had Hugging Face on the show earlier today, the Equality Show, thinking about AI ethics in particular, but this is a company that's thinking about open source foundational models.
Yep.
Do we end up in an open AI eats all our lunch sort of environment, do you think?
I mean, I think this is where we're starting right now. There's a big opportunity for new entrants, especially in specific spaces. So healthcare is definitely one of those where, large language models that are built on public information are not going to be as relevant in the context of clinical care. That being said, there's still a lot more to be built on top of OpenAI, and we're seeing those types of integrations. I think Rebecca has a very good point. It takes a lot of compute to build something new. It takes a lot of hardware. That's why we're seeing what we're seeing with NVIDIA. So it's going to be difficult for a new player to start from scratch, but that doesn't mean it's not going to happen. I think we're going to be surprised what comes to the market, and we're keeping our eyes and ears open to see what's out there.
Yeah, I think one of the things that's really, really cool about this is that it creates opportunity for new user experience. The idea of creating new tools and products that are fun and create something different for the user to interact with. We haven't seen as much of that in the last, set of years. And there's an unlock here where if by using it you make the platform stronger, the differentiation might be that when you think about AI-driven learning or AI-driven consumer fintech, that user experience may become a differentiation over time.
A lot of this, of course, is built on user data. And a lot of this is thinking about the ramifications of privacy, of fake news, of also, ultimately bias. We sit here as three women, and a lot of the data is old, doesn't quite run on as diverse set of data as we'd like to see. Yeah. Rebecca, do you think self-regulation, overall government regulation, is the way that we're going to end up going for AI, do you think?
I think it is probably both. My hope is that we have learned lessons from previous iterations of technology shifts, and so we are not entering this one cold. And so we've learned that if you just build with no view towards future problems around data and privacy and bias, it becomes too late too quickly. It's very hard to adjust. And so you have to think about them early. As we know, over-regulating stifles innovation early and has a significant risk to it. Under-regulating creates downstream massive problems that are hard to resolve later on. So my hope is that it's a combination of both and forward-thinking in a measured way.
Because there's been criticism, in fact, from Hugging Face, that this whole humanity is going to become extinct because of AI is kind of a bait and switch from actually the bias is already here in facial recognition when the police are adopting it. The bias is already within the AI data. How do you think the narrative of regulation is going in the US? And when you look at what's happening in Europe, do you have confidence, trust, ultimately?
I mean, I think this narrative of humanity is facing extinction is something that you've seen historically whenever there's any new major platform shift.
Yeah.
I mean, even from the old Jetsons cartoon, right? So that to me is not surprising. That being said, I think that the sort of empathy that you're seeing from AI and the real sort of humanness of the language is something we've never seen before. In the healthcare context, there was a big empathy study that was published in JAMA that actually showed that AI was more empathetic in patient interactions than many clinicians. That is fascinating. And so that
they're not exhausted.
It's exactly, they're not, but they could be replicating the bias that's systemic in healthcare as well. And to your point, I think the right balance, that Goldilocks situation, is something we still need to find. But I think it's going to be a while before regulators and, frankly, even the rest of us know exactly what that looks like.
And when we see the explosive growth that you can't see behind you, but growth in generative AI, absolutely rocket ship at the moment. And we're still trying to understand, ultimately, the value that's created from a dollar perspective.
Yes.
Do you think, Dina, there's been a bit of hype, like we look towards ultimately the hype that we saw in crypto, and some now say coming back down to a more normalization, or whether it's some winter for the foreseeable. Is AI hype or reality from your perspective in terms of the money being put into it right now?
I mean, I think it's a little bit of both. There certainly are funds who are dedicating, hundreds of millions of dollars just to investing in AI now. And I think the fact that, our grandparents are talking about it the same way they were asking about crypto just a few months ago says something. That being said, I think any tech investor will tell you that this is a real, actual seismic shift that is going to change the way that technology is produced and consumed for decades to come. So I think it's a little bit of both.
There's been some hand-wringing as well about the race. Whether it's a race in the US, we've got Rishi Sunak from the UK over wanting to say that they're a big player within the United Kingdom in AI. And then we look to China. And it seems to have added yet more fuel to this geopolitical tension fire. Rebecca, do you think we have the right to be saying that? Is it realistic, some of the worry that's coming from Silicon Valley and indeed from New York in general?
I think that oftentimes with technology shifts, first doesn't mean best, right? It takes time to develop the right tools and perspectives and platforms that overall become winners in the category. So I think race has to be contextualized. That being said, do I think it's an important time in the history of our country to make sure this is the best place to be building new technologies and innovations? Absolutely, yes. I think there is new risk to that. I think that the speed of technology building outside of it has also accelerated. Some of that is good, but it's important to this country to be the best place to build new ideas and to create these platforms. And we need to make sure we have the environment to do so.
Is it? I mean, like I'm looking at the crypto sphere right now. We had Brian Armstrong on yesterday. You've just been talking about Binance in the show earlier. The regulation here in the US seems to, some would argue, be retrospective in its action and driving talent away. Are you seeing that at all, Dina, in people building?
I mean, we're seeing some extraordinary companies getting built and some really talented folks. So I'm not too worried about that yet. But I do think that if the regulatory environment goes a little overboard, we're going to see some more risk there. And so that balance needs to be had. But, you know, I'm from Silicon Valley. I'm a little bit biased there, although New York is pretty cool too. But I think there still is a bastion of talent, and San Francisco is thriving right now, despite what is, what is often seen on Twitter, with incredible young people who are putting their minds to work. I think it's the most popular theme right now in the current YC Combinator class, and
Yes.
so I expect we'll see lots more to come.
Talking of YC, it's interesting, they are at last returning in person. I think this is the first time we're going to be seeing them coming. And interestingly, whether or not that's particularly international in its nature of founders. And I'm also interested in what diversity we ultimately see in those founders. How are you seeing that landscape shift at the moment? Because we're in Pride Month, we're in thinking about, there's a lot of worry in the macroeconomic environment that people return to how they're used to writing checks, to the people they're used to writing checks. Are you seeing that, Rebecca, or are we still seeing money going to diverse CEOs, founders?
I think it is a tough time. I think when the markets shake and get more challenging, people pull back on things that felt experimental and go towards the things that they have seen success in. And often that hurts diverse founders the most. The numbers are out there. Last year was pretty abysmal in terms of funding for new diverse founders. My hope, though, is that we are going to see some real success from diverse founders in this economic environment. Diverse founders are often more used to operating under constraints without as much capital as they might desire, without believing that they can always fundraise. And so sometimes a market that feels more foreign to some types of founders feels actually very comfortable to diverse founders who have built their businesses under similar constraints. And that might allow them to thrive in this environment and show that that's where success can come from. But right now, it's been a very difficult market for diverse founders.
Are you feeling the same? Is that it felt like there was a sucking sound at the beginning of the year, and everyone was like, "Oh, please don't let that be true." Is it?
I mean, I'm of two minds. I definitely, agree with the headwinds that are facing a lot of these founders. That being said, I think if you look at the data, you look at who's performing better. If you look at public market indices, just speaking about women, there are many different facets of diversity, but women perform better across the board.
I think we've got a chart to show when they're ready to bring it up.
There you go. Exactly. Women on boards, women CEOs. We're talking faster time to profitability, and overall across every metric, better performance. And so, smart investors who are looking to make smart investments are looking at data points, and that's one of them. If you look on the private side, I think some of the most successful companies we've seen, even in this downturn, happen to be in women's health, an area that was historically underinvested in, and now is actually seeing up rounds, which is fairly remarkable in any sector right now, but particularly in healthcare. Companies like Maven Clinic, whose board I'm on, for example, and I expect we'll see more of that. Finally, dollars being put to work, a massive part of GDP, and many of these founders happen to be women.
A lot of money got raised prior to this macroeconomic headwind, and you've got dry powder. Are you able to write the checks you want to at the moment?
We are. We just announced our 8th fund, and we are super excited to put money to work. We believe this is going to be the most successful vintage. I think historically we've seen that in other downturns. And the fact of the matter, as Rebecca said, is it's probably never been harder. It is going to take so much grit and resilience, and all of that, I think, makes extraordinary, strong-willed founders with incredible conviction, and we're out there looking for them. So we're still investing, and we're excited about what's out there.
And where is it most competitive? Is it the seed rounds? It's a very early stage. Are we ultimately having to just hold our breath a little bit on big later rounds for the time being, Rebecca?
Yeah, so the seed market has stayed the most competitive by a pretty significant margin because that's where the capital is kind of condensed. As you get later, A, B, C growth, it's gotten slower and slower, but that also creates a lot of opportunity. We are excited about those Series A and Series B's rounds. There are great companies being built. There are ones that are still seeing momentum despite difficult headwinds, and there's less capital. And so from an investing environment, it's pretty exciting. And I also think, companies are building with different priorities in mind, with strength of unit economics, with, foresight to profitability in the future, with some of the pillars that we've always believed are going to create long-term, very successful businesses. And they're highlighting them and prioritizing them earlier in their journey, which is exciting to invest in.
Do you think the talent pool is richer at the moment or not? Do the startups have the bandwidth to be able to pay what some of this talent that is coming out of big tech are waiting for to be hired again?
I mean, that's one of the things that's really exciting. There has been such an unlock of talent with all these layoffs. We've seen extraordinary people to our benefit who now are open to joining startups, to starting companies, who have the ability and the bandwidth themselves to do that. And who understand the value of equity and sort of the tumult that it takes to really start off early stage and get to that. So we've seen a lot of that, and I think we're going to be seeing more to come.
And what about the companies that we were all excited to see go public, the Reddits, the Instacarts, the whoever it might be? They must be having to think creatively as to how to satiate their talent right now without this big liquidity event that was potentially on the horizon. Do you see do you see IPO markets starting to come back, or are we so far away from that at the moment, Rebecca?
I find it very hard to predict, but I think that the patience is going to run out of some of those companies that have been really waiting and feel ready to do so. The ones that were more on the edge, the ones that the unit economics are shakier, may wait, but I'm not an economist, so I don't know, but I have a suspicion that we will start to see people push out because they feel the strength of their business and they just don't want to wait forever. And that will be interesting to see. There are some really exciting businesses waiting in the wings that I think we could see go public. But to your other point, I do think that it's creating an interesting challenge and environment of how to satiate those employees who have been waiting there. Sometimes when they worry that the prices that those marks are sitting on are no longer viable, or that the liquidity event is further than they believed. Difficult and challenging for very late stage companies, another opportunity for some of the earlier stage companies that might have their eye on talent that they previously weren't able to get.
It's funny, isn't it? That was a bit sort of, ultimately we see this conversation is a cloud with an enormous silver lining that everyone can't stop talking about, which is AI. But I think about when our Bloomberg Technology show was reborn in its new time slot. And it was the day that, we saw Silicon Valley Bank go under, ultimately be rescued. Are we still talking about that? Have we moved on in some way, Dina? Have we, from the ashes of that, started to see success?
I mean, we all have our stories of where we were, what we were doing.
Are you scarred?
There's definitely some scar tissue there. And I think, again, I'm not an economist either, but it's clear that there's still more to come from that as well. But at the same time, the sort of juxtaposition of that with the excitement around what we're seeing in AI, overall, there's still a lot of appetite. And so it didn't have the sort of apocalyptic effect on the industry that some feared that it would. And certainly the efforts of the government, I think, helped to make sure that that wasn't the case. But we're still, people aren't really talking about it. It's kind of yesterday's news. Now it's the smoke and, the debt ceiling and several other things that we'll be seeing.
But did it make you or your networks closer in that moment? There was this feeling that there were a few very loud, slightly older white guys basically on Twitter sort of shouting about the need to save certain banks or not. But behind the scenes, I'm sure there was amazing collaboration.
Oh, there was so much.
Yeah, it was an amazing moment of seeing the help that an industry can provide to each other. We actually recently sent out to our portfolio just the stats of the emails that were traded that weekend and the help that was given between a portfolio of 120 companies. And it's astounding, and those are moments. But I also think it's a reminder that in the face of exciting innovation and a lot going on, there's a lot of macro uncertainty, and it looms, and it can come out and rear its head. And ultimately, it matters that you don't build companies in a vacuum, no matter where you're building them, and you have to have an eye towards the macro condition you're building in.
So to leave us both of you said you were AI optimists. Both of us have talked around the clouds and the silver lining. One application or one technology that you're really excited about in 2023 going forward, Dina, before you?
Oh, we're not supposed to pick favorites, but because I have my co-investor here, I'll talk about AI and women's health, and particularly infertility, which I think is really exciting, and I think sort of emblematic of various other applications in this space. And this company, A-Life, is using AI to make the 1 in 6 people globally who cannot have a baby have the potential to do so. And they've been doing so for years before we were all talking about AI. And they're doing so by recreating the data set that informs the clinical protocol, which is critical to actually making sure it's good data in, good data out. So that's one example I'm really excited about.
I'm excited about AI intersecting with learning. I think, how people get educated and the relative bias and access to that has been really challenging in this country for a long time, and the ability to democratize access to very high quality personalized learning will create big business opportunities and a lot of changing landscape for learners at all stages of their journeys, and will be really exciting.
I like it. It's about birth and it's about equality of those children who are being born. We thank you so much. What a wonderful conversation. Always flies by with these two. We thank Rebecca and Dina, and we thank you for also being engaged. Thank you very much. Thank you.
Please welcome to the stage Nuveen Equities and Fixed Income President Bill Huffman, Blackstone Global Head of Strategic Partners Vern Perry, and Lazard Head of Capital Markets Advisory Marianne Degnan with Bloomberg's Kriti Gupta.
Bear with me. Listen on this side. Hi there. Good afternoon. Almost there, guys. I promise this is the best panel, best for last. The title of this panel is kind of interesting. It's 3 different perspectives of the theme of pressure. Everyone faces pressure in this industry, but there are sections of this market that are more under pressure, for lack of a better term. I'll find another word in a sec. And I think we have the 3 best guests to kind of talk about it. So let's start there. Bill, I want to start with you. Where are you seeing pressure in this market?
Well, I mean, obviously, in the alts market, with coming out of the pandemic and having all the public markets, collapse all at one time, in the alts market, there's a little bit of delay in terms of what happens. So now you're starting to see in the alts market pressures around, credit defaults, cash flow in terms of deals, and so with that, you have to have an organization that has scale, that has to have a globalization to it, so they can get the deal flow to come up with and optimize and try to come up with different types of strategies.
How much of that, though, is a pandemic hangover as opposed to kind of a more traditional end to an economic cycle?
I think it's a pandemic hangover because, alts have been on such a growth trajectory over the several years, for the past decade or more. And as you come out of the pandemic, the global financial crisis, things kind of took off again. But the pandemic, things are just still kind of moving around. There's various issues in terms of, what's going to happen next. And so I think it's definitely a hangover.
Marianne, let's come to you here. Your expertise is capital markets. When I think capital markets, I feel like the easy thing to go to is, people aren't IPOing anymore. Done. You go obviously into the nitty gritty. Talk to us about pressure you're seeing across your universe.
Yeah, so slightly different perspective on pressure. I see pressure in public company boardrooms and in the C-suite of public companies. The investing and operating environment has changed so dramatically in the last 18 months, and really arguably since the very end of 2021. And unfortunately, there are many business plans and strategic paths to value creation that have not been refreshed and have not been updated for the fact that the cost of capital is dramatically higher for most companies than it was. The cost of doing business is much higher. Supply chains have been disrupted. Labor markets have been disrupted. And so there's a lot of pressure from activist shareholders and just generally unhappy shareholders in C-suites and in public company boardrooms.
I got to say, one of the best parts of my job is as a financial journalist. It's a little kind of playing doomsday every day. If there isn't a crisis a day, I don't get paid. But one of the really interesting pieces of my job is I get to ask the questions, and I get to get away with not having the answers, which makes your guys' job extra tough. Vernon, let's come to you here.
Sure.
One of the biggest parts of navigating this narrative has been, what does it look like in the past, right? The 70s, the 80s, the 90s, are there kind of roadmaps that could perhaps provide visibility for the future? And I think the clear answer is, well, this has never happened before. It's unprecedented. When it comes to kind of issuance and primary, secondary markets, where's the pressure?
It's a great question. And I'll come back to 2009, talking about markets. So if you see the pressure on the private equity side, it's really on private equity allocations. So lots of large investors in private equity funds are over-allocated to private equity because of two dynamics. The first is called the denominator effect. So private equity allocations and commitments have increased significantly since 2016. Then you have in 2021, at the end of 2021, throughout 2022, public markets pulled back. As a result, private equity allocations increased significantly, almost artificially. So if your target was 10%, you may find yourself at 17%, 20%. So it's hard to keep doing new deals, new commitments, when you're already over-allocated to private equity and over your targets. And so a lot of pressure's there. What's exacerbating that issue is that distributions are down. So if you look at distributions in 2022 versus 2021, they were down about 40%, 50%. Depending on the fund type, it could have been 70% or more. And so what you're having is large investors in private equity funds that want to commit to new funds, but they don't have the capital available.
Well, it's so interesting that you mentioned kind of the 17-20% allocation. I think in an earlier Bloomberg Invest panel, we had a member of Ares Investment Management talking about how, you know, there's the usual 60-40 dynamic, but if you really look at that, it's really saying 100% public, 0% private. And that dynamic has been completely flipped to where a lot of people are saying, maybe it should be 50-50, not bonds and stocks, but public and private. Completely changes the game in terms of the roadmap. You mentioned the financial crisis, though. We were talking about the pandemic hangover with Bill. Walk us through kind of the perhaps hangover from 2008 that we're seeing now, what, 15 years later?
Yeah, I don't know if there's a hangover per se, but I'll go back to 2008, 2009. The similar dynamic occurred where there was a denominator effect. Public markets pulled back significantly. Private markets didn't pull back nearly as much, and as a result, private markets as an overall allocation was a lot higher. So what happened was investors did one of two things. They sold in the secondary market, and that's what I do for a living. They went out and sold older funds, 8, 9, 10-year-old funds, to free up allocation to invest in newer funds so they can continue to stay current in the market with GPs. The other thing they did, for some, they just stopped investing. That's a problem. When you think about the 2009, 2010, 2011 vintage years, those are vintages you want to lean into. You shouldn't be out of the market. And so what we're seeing now, a lot of investors that are over-allocated are trying to stay the course. They're slowing down. They're selling on the secondary market. They're making smaller commitments to fewer managers. But by and large, I see that investors are trying to stay the course and stay current in the market by staying invested and committing to newer funds.
It kind of feeds on the topic of appetite at the end of the day. And I'd not mean to use the word feed and appetite in the same sentence, but here we are. Marianne, let me come to you on that question of appetite here. In 2008-09, major systemic shock, one that I think we faced again in 2020 when it comes to things like liquidity. In your universe, how much of a kind of scare factor is there when it comes to this conversation of liquidity, of a potential systemic shock, especially in the context of the banking kind of turmoil we've just been into? Is that something the folks you're working with are talking about?
Yeah, well, again, in the C-suite and with boards of directors, there's a tremendous amount of focus on how are you going to finance your capital plans. Capital allocation strategies, in many cases, have been built for a different environment where there was seemingly endless liquidity. The cost of capital was cheap, and that has changed. Not only has the cost of capital changed, but the availability of capital for many companies has changed. You made reference to the now almost disappearing IPO market. Let's hope things are starting to normalize there a little bit. We're starting to see some signs of thaw. But companies really have had to re-envision what their future looks like when they really have to question how am I going to access capital and how am I going to fund my growth plan? And if I can't fund a growth plan, if I can't clear my return hurdles based on new cost of capital assumptions, what is plan B?
Yeah. All right, Bill, what's plan B? Just kidding. Well, talk to us again about the story of systemic shock here and liquidity from your universe, where you're dealing with a little bit more with public markets, but also kind of with the alternatives here. Where do you see the issues of liquidity, the issues of kind of a disappearing IPO market, of the secondary issuance story? Does that feed into perhaps appetite for this public-private allocation?
Well, sure. I mean, there's when I think about the public-private and the alternatives, I mean, people have to get uncorrelated returns. You know, that's what they're looking for. And so they don't want to just be in the 60-40 split of, you know, public equities and bonds. So as they move towards this, they look for things that are going to provide that return, that there's going to be a shift to, you know, search for yield, and, you know, an organization that can bring, you know, access to capital, meaning they're investing their own capital, along with finding the third-party capital. Now they're aligning their interests, and they're investing together. That allows them to then go out and find interesting ways to finance deals. So say in the private capital space, you know, you can do private credit, you can do junior capital, you can do private co-invests. And if you can optimize those, you can bring interesting investments to the client and solve what the sponsors and private equity firms are trying to do. Well,
I mean, the magic of markets, at least what attracted me to them, is, you know, you can talk geopolitics to your heart's desire, but markets are really interesting because it's this you're taking a really massive bet on what you think the future looks like, and there's a lot of trends underway already. We've talked about the AI frenzy, we've talked about ESG. When it comes to kind of mega trends, what are you seeing?
Well, I mean, I think about three things in the mega trend. You know, you've got your democratization of alts, you've got ESG, and you got a movement in to move to low carbon energy. So when you see those things, say democratization, if you look at private credit came out of the global financial crisis, banks pulled out, private credit went in. You had institutions investing in this. It's a market that grew to today 1.7 trillion. It's expected to grow to 2.3 trillion by 2027, 50% increase. Bringing that democratization down to the, you know, a wealth client, went from institutions to wealth, can go even further. That market's going to continue to grow, and that's a big part of the alts market in terms of democratization of it.
Well, let's stick with that theme of democratization. Marianne, this has been an issue when it comes to, I think, capital markets broadly, both on the kind of the debt issuance side, but all the equity issuance side, and I think more popular with kind of the latest cycle of IPOs, and especially in the conversation of retail investors. How do they access the newfangled kind of securities on the NYSE or the NASDAQ or wherever it is you choose to list? How are you viewing the concept of democratization?
Yeah, so I think of it under the umbrella of shareholder rights, and shareholder rights are expanding, and shareholders are becoming increasingly vocal and demanding. And that covers any category of shareholder that you might want to create. Three big categories that I think of and that I help our corporate clients think about. One is the index complex. They are stewards of trillions of dollars of capital, and while they may not trade in and out based on fundamentals, they vote their shares, and they care deeply about principles of governance. And so they want to be heard, they want to be considered, they want to be engaged with, and they want to be acknowledged. And so one big megatrend is the connection being made to this pool of kind of forever capital. A second bucket is what we might think of as a more traditional institutional equity manager, mutual fund, pension fund, many stops in between, hedge funds. They have become incredibly demanding, right? They are quite vocal now when they're speaking to management teams. It's not just message push from a corporation out to a market, to a shareholder, there's real dialogue, there's real back and forth. I mentioned shareholder activism, but it's an extraordinarily, I think, enduring trend of shareholders making their voice heard within the C-suite. And then the last group is retail. And there are a lot of efforts underway to not only give the retail investor access across all markets to different products, but also give them a little more control with the vote, pass-through voting, right? The notion that an individual investor can not only make their own fundamental investment decision, but that an individual investor should also be able to take responsibility for voting their shares. So there's a lot of really interesting trends.
I feel like I'm having a little bit of kind of Succession deja vu as we talked to Marianne a little bit about it. Verdun, let's come to you on that concept. We talked about kind of pressure, democratization. I want to tie that with the story of liquidity, because it's not just about kind of retail folks getting access, but even regular everyday people who are in this market are having trouble with access. How do you fix a problem like that?
Well, I'll talk about private equity, and I'll talk about how it feeds in the secondary market. So if you look at private equity commitments to funds, they've increased fourfold since 2009. The number of active institutional investors committing to private equity funds during the same period of time has increased sixfold. The secondary market volume has increased tenfold since that same point in time. So we talk about pressure, let's talk about ways to alleviate that pressure. One of it is the secondary market. That's a mega trend. 23 years ago when I started in this business, total volume globally was about 1.4 billion. This year, it should be about 130 billion. But when you think about that, that only represents about 1% of all available capital out there in funds. It's tiny. That penetration rate or turnover rate is exceptionally small. Over time, through awareness and a need, whether it's a latent need or you're aware of the need, people will pursue exits and liquidity to relieve the pressure that we're talking about today through the secondary market. And I think I'm excited about that because there's one thing that's for sure, we've seen pressure before, this too shall pass, but for right now, what do you do about it? And I think one of the answers as it relates to private equity and the pressure caused by overcommitment to funds is the secondary market.
Well, in terms of, you use that word exit, and I think that's almost, it feels like the market's worst nightmare here, because as we talk about exiting private equity or private markets in general, there's also this exodus coming out of public markets as well, or at least a complacency or a hesitance to get back in. Bill, weigh in here. When it comes to kind of this concept of mass panic or mass exodus or something like that, how concerned are you? Or are you perhaps seeing, as we wait for this recession that at some point will come, I'm waiting for 2 years, is there some sort of read-through or trade-off between the public or private, or do you kind of see some sort of return to what we've been seeing in the past couple of decades, some sort of return to normal?
Yeah, I think you're going to see a return. One is, I think investors today are holding on to cash because they don't know what quite to do with it. You know, the equity markets are volatile, rates are going up, they don't want to put their money into that. They're learning, you know, with the alts markets, you know, as we've talked today, with the alts markets getting more and more available to the individual investor, they're waiting to see what kind of information can come to them. How can they invest? And as they get more information, they'll be able to invest. And that trend's not going to stop. They're going to have these uncorrelated returns to their portfolio. It threw them off in the pandemic when everything dropped to the bottom, and they know they have to have these other investments.
I like that you mentioned the concept of information, because, Marianne, I think this is very relevant to what you're talking about, kind of this growing shareholder base. We've talked about access to the securities themselves. Let's talk about access to the information in terms of making the right trades or bids or investments or whatever you want to call them. Is that an issue you're seeing with this kind of growing retail shareholder base?
Well, I think in some cases people are quite concerned, and it's probably not as big a concern as some make it out to be, but it's also probably a somewhat bigger concern than others make it out to be. For example, let's take the case of a large M&A transaction. Maybe it's highly complex, maybe it's very sophisticated, maybe it has some industry-specific or deeply complicated structuring nuances, and you have a large retail base. How do you communicate with that audience about some of those nuances in the context of a big M&A transaction.
Yeah.
They're going to vote this deal, right? Are they going to vote for it? Are they going to vote against it? And based on what? So I think there's a lot of golf to play on that issue. I don't think it's particularly straightforward, and it's not black and white.
Yeah, and something I think that's going to get even more complicated as you get more and more, not just, I want to say, investors in one country, but it becomes a truly global phenomenon. In our last about, let's say, 90 seconds here, no pressure, let's talk about what keeps you up at night here. What is the thing that you worry about? Verdun, let's start with you.
I wouldn't say a lot of things keep me up at night, but...
Really? You sleep really well?
I don't sleep a lot, but when I do sleep well. What I would say is certainly geopolitical risks. I would say lack of liquidity. I think my fellow panelist was spot on. The cost and availability of capital, cost is increasing, the availability of capital is decreased. And so that worries me a little bit. You look at the exit market, the IPO market, for all intents and purposes, is non-existent right now. And so as an investor, you're investing to get a return. The question is when. Yeah. So certainly there are going to be longer hold periods, which will apply more pressure. We started with that. It will apply more pressure. So I think about when I make an investment, when is this capital going to come back? Clearly, what is the return going to be, but when will it come back? That's the important question. So that's what keeps me up at night.
Well, thank you for doing my job and connecting it to the beginning. I can go home now. Marianne, what keeps you up at night?
I think just being humble enough to know there's a lot of things out there that we still don't know. And I think sometimes we in this world, and this sophisticated financial world in which we live in, we feel like we've been able to study everything. We know where every risk is. We've evaluated it. We've priced it in. And we're ready for it. And I think history has proven that's not true. We're never really fully on top of the unknowns. So I worry about the unknowns.
Good financial advice and life advice. We'll get it on a T-shirt. Bill.
I think about just being nimble. You don't know where what's going to happen next, and so you have to get nimble. You have to move quickly. If you want to move quickly, you can make the right investments. If you make the right investments, you can grow your revenues and things like that. So it's always trying to be nimble and make the right calls. So you're always, I'm always thinking about that as the next step.
Well, when you guys get tired of making the right calls, maybe you guys should join the financial media. We're doing great over here. Thank you guys so much for your time. We really appreciate it. Fascinating perspective. Thanks, guys.
Yeah, you want to start one?
Okay. Hi, I'm Tracy Alloway.
And I'm Joe Weisenthal.
And we are the hosts of the Odd Lots podcast.
So, Tracy, what do we do here at the Odd Lots podcast?
We have the most interesting conversations about the most interesting stories in finance, markets, and the economy. And we always try to do so with the perfect guest.
And you can find us on all the major podcasting platforms, including Apple Podcasts, Spotify, and now catch us every Monday on Bloomberg Originals.
Thanks for listening.
Thanks for listening. Do we say that, yeah?
No, we don't, but we could.
Please welcome to the stage actor and author of Easy Money, Ben McKenzie, with Bloomberg Odd Lots co-hosts Tracy Alloway and Joe Weisenthal.
All right. Thank you, everyone. Thank you, everyone, for coming. Just a real quick housekeeping note. So we are going to record a live episode of our show on stage. And as such, if you don't mind, try to keep cell phones off, movement to a minimum, moving in and out just because it all might get picked up. And as a reward, there will be drinks after the event. So thank you for coming. And shall we get started?
Let's get started.
All right. Hello and welcome to another episode of the Odd Lots podcast. I'm Joe Weisenthal.
And I'm Tracy Alloway.
Tracy, that intro video they showed, we use our line, the perfect guest. But this week, of all weeks, we have a really good guest.
Yeah, this week it's actually true. We're going to be talking crypto, actually, with someone who you wouldn't necessarily expect to be the perfect guest to discuss crypto.
No, but he is. So obviously, this week we're recording it the same week after the SEC filed suit against both Coinbase and Binance. So we're going to be speaking with Ben McKenzie, a well-known actor and the author of the forthcoming book, Easy Money, Cryptocurrency, Casino Capitalism, and the Golden Age of Fraud. Ben, thank you so much for joining us. How did you arrange that, sort of like from a PR standpoint, that you got the government to file suits against Coinbase and Binance as a lead up to your book? That was very well done.
Yeah. I had nothing to do with it, but I'm very grateful. And if they could just hold off on any DOJ pending action until
Just wait until
July 18th, that would
July 18th. Okay.
That'd be wonderful.
You're going to have to keep rewriting the epilogue, I think. Well, why don't I ask the obvious question, which is how does an actor get into the profession or hobby of investigating cryptocurrencies?
Sure. There's a longer answer. The shorter answer is a sort of a mini midlife crisis, it was the fall of 2020. It was the height of the pandemic. And I came down with a serious case of FOMO. I saw all these knuckleheads getting rich, and I thought, hey, maybe I should, try to get rich as well. In a roundabout way, that led me to crypto. A very good friend of mine, who in my 20s encouraged me to invest in a obscure medical device company and that was going to create synthetic blood, and it was going to make a ton of money. A random guy at a wedding had assured him so, and so we definitely needed to invest in this. I put money into it and promptly lost almost all of it. Might have been a penny stock pump and dump. Anyway, that same friend came back to me in 2021 and said, "You got to buy Bitcoin." And I thought, I wonder, what is this cryptocurrency stuff? So I have a degree in economics from the University of Virginia. It's about 20 years old. So I dusted that off. And I ended up writing this book. So as to why I'm here, I would say the book is really about money and lying, right? And I know about money because I have an econ degree and I made a little bit of in 2 decades of show business. But I know about lying because I'm an actor and I do it for a living. And so when cryptocurrencies were calling themselves currencies, the first thing I bumped up on was the word. As an actor and a storyteller, words are tools, and they can be used for a variety of purposes. Some of them are honorable and some of them not. And although Bitcoin, of course, was intended to be a currency, that was the intention, supposedly, of Satoshi Nakamoto, it had never really functioned that way, right? And it certainly wasn't functioning that way in 2020, 2021 at the height of the mania. So that's where I started. Like, if these aren't currencies, so what are they?
So the friend came, and you already had this view, okay, this is the guy who lost you a bunch of money. And so rather than, because you said you had FOMO, so a lot of people, like, they just went out and bought. Yeah. And your first instinct was like, brush off the old economics books. So But where did you, so you didn't, like, plow your money into crypto at the top.
No.
But that's still, like, how did you sort of begin your exploration of this industry?
Sure. Well, I read a lot of. So first, I needed to understand, like, okay, where were we? And in 2021, I very quickly came to the conclusion we were in a bubble. A fairly obvious bubble, perhaps in retrospect. But the book is called Easy Money, not just because of this fake money called cryptocurrency, but also because of the easy money policies that have been around since GFC and that went nuts. During the response to the pandemic. Right? Trillions of dollars jumped into the economy, and by the time I was thinking about entering the market, everything had gone crazy. So I took Gary Gensler, the head of the SET. He taught this course at MIT on blockchain and crypto, and it was available for free online. And again, I had a lot of time on my hands, so I took that. I read a bunch, and I was stuck with the feeling that, so fraud, historically speaking, runs rampant during easy money times, during bubble times, for fairly obvious reasons, right? When there's easy access to money and credit, people speculate wildly in search of high returns. Some of those, innovative technologies are truly innovative and people make a ton of money, but some of them are fraud. Charles Kindleberger's studied this, extensively. And so I felt like there probably was a lot of fraud, and that became kind of a pandemic hobby of mine, betting against fraudulent companies and stuff like that. And around that same time, my friend Dave came to me and said, Bitcoin is the bee's knees. And I was troubled by Bitcoin and crypto because it was everywhere, and the celebrities were selling it, and it was, the Super Bowl was going to feature it heavily. And I thought, look, if I'm right, and maybe I wasn't, if I'm right, this is something like the biggest Ponzi scheme in history. That troubled me. So I was actually reading my daughter The Emperor's New Clothes. Daughter is, yeah, it sounds made up, and I probably I was probably intending, like I was like, you know, but I did see it on the shelf, and it did happen organically. She was 6 at the time. And I remembered the gist of the story, but I had forgotten a couple of points. The first, the tailor's trick, everyone, basically an appeal to ego and status worship, right? Only the smartest people can see this, only the people of highest station. And the second thing, the thing that really stuck with me, was at the end of the story, as the emperor's gallivanting through town naked, and the adults are pretending not to notice, it's a child who calls out the scam. It's the only person brave enough to call truth is a person who doesn't know he's being brave. He's simply speaking the truth. Well, it was hard not to see myself as the child in that metaphor, right? Like, what the heck do I know? I'm just an actor. I have an undergraduate degree in economics, 20 years old. But I don't know. Maybe I'm right? And how often in life do you get a chance to have an adventure? So I got high. I got my medical marijuana card over the pandemic because, you know, I like alcohol, but like there's a limit, you know what I mean? And, right? And I was definitely over it. And so I got high, and I was like, well, I should write a book about...
It's really retro that anyone would, like, go to the... Now that they literally sell it everywhere on the street,
yeah,
that someone would go to the effort of, like, getting a card.
No, I'm such a, like, goody two-shoes, right? I have my card, and I, like, overpay for my marijuana. Like, but, yeah, I got high, and I was like, I should write a book about crypto, and which sounded like... It sounds like a really good idea when you're high. The next morning, sober, I realized I didn't know how to write a book. So I got high again. And I realized this journalist, Jacob Silverman, had written an article that I really found quite funny. It was called Even Donald Trump Knows Bitcoin is a Scam, which was basically Trump didn't really criticize crypto until he left office, and then he was like, oh, it's a scam. It brought together a couple things I've been thinking about, golden age of fraud and all that. So I summoned the courage to DM him on Twitter, as you do. I realized he lived in Brooklyn and took him to drinks and said, hey, what if we write a book that I don't know how to write about events that haven't happened yet? And he was going on parental leave, and he foolishly agreed. So you're off to the...
I love that during the depths of the pandemic, while other people were getting high and baking sourdough bread or watching Tiger King, you were like, I'm going to launch an all-out investigation into the cryptocurrency market. Well,
I'm a weird guy.
You touched on the easy money aspect of it and also the FOMO, but can you talk a little bit more about, like, what is it that makes cryptocurrencies so attractive to so many people, and particularly one segment of the population, it seems, which would be young men? Like, what is the attraction there?
Well, that's a great question. So I kind of look at, as a storyteller, I became fascinated by Robert Shiller's work, right? The Nobel Prize-winning economist who's talked about how economic narratives form and their response to real events, right? And so the Bitcoin white paper's release in October of 2008 was at the height of the subprime crisis, and there was an understandable mistrust of legacy financial institutions, banks, all that. Banks were even more unpopular than they often are, and so the timing was perfect to set in motion the notion of a theoretically peer-to-peer currency. It didn't really work. It didn't take off for a while. But I think, to back up, the reason that I think crypto appealed to so many people in so many different ways and so many different types of people, 40 million Americans bought crypto, is that they could kind of see anything in it that they wanted to, right? I mean, on one level, it's very simple. It's a get-rich-quick scheme. But on another, the people that were interested in sort of like libertarian politics could do that. The people that wanted to build, it was marketed as a generational wealth builder. It was marketed as a way to unbank bank the unbanked.
Also the next big thing on Wall Street at the same time.
Exactly. Well, it was marketed as the future of money, and all you needed to invest in the future of money was the willingness to part with the current version of it. Yeah. So it had a very broad, which was also one of the reasons why I was so skeptical of its authenticity, was that how can it be all of these different things at the same time? And yet, of course, it wasn't a currency, so then what the heck was it? Well, it seemed like an investment, right? I mean, people are putting real money into it, hoping to make real money off of it, that sounds like an investment contract to me. So I had to figure out, how did Bitcoin come to be classified as a commodity, which is sort of an interesting, sort of dorky story. And then what the heck were these 20,000 other things?
One of the things that's a little bit surprising or sort of interesting is that for as much talk about crypto that exists, like, it's not that big. Like, the total value of all the coins, I think, is like around $1 trillion.
Supposedly.
Supposedly, and then we discover, and you've reported this out, like it's small. There are a lot of people who are just like on a group chat together, and they're all important in industry. Can you talk about how big is this industry? How real is this industry in your view?
It's much, much, much smaller than that $1 trillion number, or that market cap number. So and you don't have to take my word for it. In March of 2022, I was at South by Southwest. It was my first venture into the real world. Jacob and I had done everything virtually up to that point. I ran into a guy named Alex Mashinsky. Alex Mashinsky was the CEO of a crypto lending firm called Celsius. It's now bankrupt. He agreed to be interviewed. I asked him how much real money is in crypto. He didn't ask me what real money was. He said 10 to 15%. He said the rest is speculation. Now, in March of 2022, the crypto market cap was $1.8 trillion. So, give or take, 1.5 trillion of that isn't there. It's speculation, it's leverage, it's all these other things. A chill ran through my, he said it sort of nonchalantly, but a chill ran through my spine because regular people don't understand that. They think when they buy Bitcoin, they have, Bitcoin's whatever it is, 26, 27, I had no idea. They think they have $27,000. But in a way, they actually only have maybe 10 or 15% of that, maybe, if they can get it out. It's not.
Can you explain,
Sure.
Can you explain that if someone has a Bitcoin on Coinbase or whatever, in theory, what's it at, 28,000 or 26,000?
Sure.
They could sell that and get 26,000. So
Yes.
what do you mean when you say it's only 15 or 20%?
Sure. Yeah, and that's a very good point, and I do want to caveat it. If you're going through a licensed exchange, well, perhaps not a licensed exchange, but one that's operating as an exchange, then yeah, you're probably good. And if you're not trying to move a lot of money, you're probably good. But the liquidity in crypto is very, very low. And Brian Brooks, who was the chief legal officer of Coinbase, and then he was the acting comptroller of the currency, and then he went to Binance US for like 3 months. He testified under oath to Congress about this. So, you don't have to take my word for it. Again, the liquidity is very little. So how does it work? Well, most of the volume in crypto runs through the overseas exchanges, right? It ran through FTX before it was shut down. It's now running through Binance, or, Binance is the biggest crypto exchange by a country mile. It's huge. But the question is, how much of that volume is real? Wash trading is an enormous part of cryptocurrency. You've seen it in the SEC charges against Binance. I believe the allegation of their first or second day they were set up was that 99% of the volume in the first hour was wash trading, 70% on the first day. I've read academic papers, that have surveyed, I think they surveyed 29 different exchanges. They found 70% wash trading on the unregulated exchanges. So it's just not there. People are able to create, I'm leaving Bitcoin aside for the moment and talking to the other cryptos. People are able to create as much crypto as they want. That allows you, if you can borrow against it, to create as much leverage as you want. When I testified to Congress in December, Professor Hillary Allen, professor of American University, was on the other side with me, testifying alongside me. She wrote a paper in February of 2022, so just a few months before crypto kind of fell apart. And she compared the dynamics of crypto to the subprime crisis. And they're very, very similar in many ways. Leverage, complexity, rigidity, plus a bank run equals a crash. The difference is, in crypto, the leverage is unlimited because you can print as much crypto as you want. The complexity is similar. All of these things are so complicated, at least theoretically, right? Staking pools and protocols and smart contracts and blah, 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 blah. The rigidity is even worse because of the things like the smart contracts. and even the code itself, it's irreversible. It only moves in one direction. So it's a blockchain that can be added to but never subtracted from. So when FIT hits the shan, there's nothing you can do. It just blows up. And if you combine that with criminal activity, a lot of people lose a lot of money. But not as much money as is claimed.
Can you talk a little bit more about the leverage example in the context of specifically, I'm thinking about FTX,
yes.
Right? Because they were sort of the trifecta of creating new tokens out of nothing, borrowing against them, and then also potentially, allegedly, using wash trading to push the value of those tokens up so they could get even more credit.
Exactly. So, right. So FTX had this token FTT. And I think you should, let's just start with the obvious. You have an exchange that's issuing its own token, right? Its own security, basically, right? And as Binance has the same. Binance has BNB. And it also has its own stablecoin, BUSD. So already you've got, potential massive conflicts of interest, right? Imagine if the NASDAQ, issued its own, we're going to trade the stock, we're going to issue the stock, we're going to... and another thing that I think was sort of, the poker chips in the crypto casinos are tethers. Tether is the biggest stablecoin in crypto by an enormous amount. There's supposedly 80 plus billion tethers out there. The biggest client of Tether, according to Protos, this crypto publication, was Alameda Research. Alameda Research supposedly bought, I think it's $36.8 billion worth of Tether. How? How did that work? How Alameda gave $36.8 billion real U.S. dollars to Tether? That seems unlikely to be true, given that Alameda had raised a few billion from VCs and allegedly perhaps had stolen some money from their clients. But how did you get to 36.8? So how did it work? I don't know.
So there's been a lot of skepticism about the existence, the persistent existence of Tether over the years. And I think both of us have joked that, in the year 2200, when they're still it's like the cockroach surviving the nuclear winter. It's like somehow Tether is going to be there is holding the peg. But it is kind of weird because it's like, it has not blown up.
Right.
And many other things that people thought were professionally run, I would say FTX and the associated entities, have blown up. What did you learn about Tether and what's interesting about it in the course of writing this book?
Tether's a fascinating company. The CFO is paid a $65,000 settlement to Microsoft for software piracy. The CEO hasn't been seen in public in many years. That public face of the company is their CTO. The Wall Street Journal reported that as recently as 2019, 4 individuals controlled 86% of Tether. So it's this very, very small company, supposedly dealing in up to $80 billion. Yeah, I don't know how much more I should say, except that that's very suspicious. And it is incredible that they've survived, but they have deep ties to Sam and FTX and Alameda, and I guess we'll see what happens.
Let me ask that question in a slightly different way, which is because I think one of the frustration for a lot of journalists is, cryptocurrencies have been around for a long time at this point, and I've certainly written my share of eulogies for things like Bitcoin. I think the first one I wrote was in 2011, if you can imagine.
Yeah, sure.
And then I did it again in 2017, and each time it comes back. So what would it take? What would be the catalyst for something like Tether to finally and definitively, break the peg and be put to bed?
These are not honest markets. I don't know how else to say it. Given the amount of wash trading and God knows what other shenanigans. Sam, in a Twitter Spaces, somebody asked him, "Did you even make these trades? Did this even exist?" And he said, "Some of it, no." So that's a bucket shop, right? I mean, that's what that is. Bucket shops were made illegal in the 20s. So in some senses, we are revisiting, a century ago. So as to why it hasn't fallen apart and what it would take, I believe it would take law enforcement action to really kind of get to the bottom of where the actual real money is. We'll see if that happens. But you're getting closer to, I mean, the cease and desist that the SEC issued to Binance to freeze their money, I think, is sort of the next thing to kind of watch, because they're clearly concerned that the money could be moved away, and that the customers, U.S. customers, couldn't get their money out.
So again, we started this conversation by noting the timing this week of what is Binance? Where did this, I mean, it's obviously massive, and there's been a lot of reporting on it, but in terms of like how you studied the company in your book, like what is it that gave it that just like such an extraordinary footprint in the global market? How did it establish this, and how crucial is it to like all of the, these fake prices, the prices that exist on Binance?
It's absolutely crucial. Binance, I don't know today, but it's, I believe actually it's still over half of the volume in crypto is spot volume trades through Binance. I think it's been as much as, I believe, 70%. So it's just absolutely massive, just dwarfs every other exchange. As to how it succeeded, I mean, Changpeng Zhao started early when crypto was at a much smaller stage. He was very aggressive about courting clients, especially big firms, to trade on it. And he funded things like FTX. He was an initial investor in FTX. And he's been very good at, Binance Global has no headquarters. There is no Binance headquarters, which is a pretty neat trick because it becomes difficult to pin you down.
There's a rumored headquarters, but we won't go into it here.
Yeah, let's not go into that quite yet, unless you want to.
No.
What there are local affiliations, right? There's a Binance US, there was a Binance Australia, I think, all these places. Well, in the SEC lawsuit, they mentioned this Tai Chi document.
Oh, yeah.
So the Tai Chi document is this allegedly a document, an internal document from Binance. It's basically, we're going to practice Tai Chi. We're going to set up locally compliant places like Binance US that are going to play nice with the authorities and follow all the rules. But the volume, we're going to push all the volume onto the main exchange. So redirect the regulators' energy towards the local shops. If that's true, then interesting strategy, heretofore successful. I believe the yen of Changpeng Zhao's Tai Chi may make the yang of U.S. law enforcement, but I guess we'll see.
Well, so one thing on that note, I mean, the proximate cause of a lot of the recent crypto drama was CZ starting to criticize FTX and the FTT token, which a lot of people, I think, commented at the time was kind of weird if you think of crypto as a sort of house of cards market that involves a few big players. It seems like a very dangerous strategy to start attacking each other. Do you have any idea or like conspiracy theory about what was going on there?
Well, I mean, I was talking to Sam. I interviewed Sam in July of last year, and then we continued a DM conversation through October. Things were clearly getting pretty bad. He talked of a stablecoin war with CZ and Binance, so there was clearly some animosity there. And then, yeah, I mean, what I know publicly, what's been presented publicly, is that Sam and his cohort, Ryan Salem, started kind of mocking CZ on Twitter, saying, can CZ even come to this country? Things like that, because CZ's a Chinese Canadian. Pretty bold strategy. And then the balance sheet of Alameda leaked, was reported by CoinDesk, and it was, you know, can I say shit show on the, okay, it was a shit show. And CZ had this chip, which is that he had a lot of the FTT token. Sam had tried to separate himself from CZ. I think they filed over a license in Malta that's allegedly that CZ didn't want to fill out the paperwork or something. It's like, you don't want to fill out the paperwork in Malta. Anyway, they couldn't pay him real money, so they gave him some, I think, but he was mainly paid out in FTT, which gave him this chip to play, right? If he has a lot of the supply. So all of a sudden there was a run on FTT. Sam's cohort, Caroline Ellison, tried to stop the bleeding by saying, we'll buy all the FTT you want at this price, and CC said, no, let the market play out. And And it collapsed in spectacular fashion. And then there was this brief moment where CZ considered buying the company and a non-binding letter of intent, which of course was immediately transformed by certain members of the media into he was definitely going to buy the company. But of course it's a non-binding letter of intent. So 12 hours later, he said, "No, I'm good."
What was your take? What was your takeaway from interviewing Sam, obviously prior to the events of November? Like, what were your interactions with him like?
Well, our interview in person was interesting. It was July 20th, 2022. It was at a Midtown hotel in Midtown, right around here. At the time, crypto had done its sort of first crash, the May crash of Terra Luna. So it was seemingly on life support, but Sam was the golden boy, right? Sam was, spending a lot of money on Capitol Hill. He was trying to get a particular piece of legislation through the Ag Committee, the DCPA. He was meeting with the CFTC commissioner. I believe he met with him at least 10 times. And he was being called the JP Morgan of crypto by none other than Anthony Scaramucci, the Booch, with whom he had a business relationship. Anyway, and he was going to buy up. The JP Morgan reference is reference to 1907 when JP Morgan and his pals had to come in and kind of rescue the financial system from collapse. He was going to come in and buy all these companies that were failing, right, like Celsius and BlockFi and all these companies. So that was the circumstance under which I interviewed him. Boy, I'll put it this way. The chapter devoted to that interview is entitled, "The Emperor is Butt-Ass Naked." So it was weird. It was really weird because I asked him some questions. I wanted to understand how he could explain cryptocurrency as what good it did. I found that answer very unsatisfying. He said he kind of tried to duck it, and then he went into remittances or sending payments between borders. I had just come from El Salvador, the only country in the world trying to use crypto as real money. El Salvador's economy, the foundation, I would argue, of El Salvador's economy is remittances. A quarter of the El Salvadoran economy is people of Salvadorian descent who live in the United States, 2 to 3 million of them, sending money home. So the government had, for reasons that we could go into in another question, had decided to set up a system, Chivo wallet, and it was suddenly going to, bring in tourists, but it was going to be a way for the Salvadoran people to profit by, or to not spend money on MoneyGram and Western Union traditional services, and it was going to be this huge boon to the economy. Well, nobody used it. It was a failure. It was a complete failure. For a lot of the reasons that plague crypto more broadly. The system didn't work. The Chivo system just malfunctioned all the time. People got defrauded. People lost their money. And so they decided they would rather stick with traditional services. So according to the government's own figures, less than 2% of remittances use this system. So I just come from there, and he's saying it's remittances. And I'm saying, Sam, baloney, BS. And then we went round and round and round. And when I came back to that same question, because the question was, give me one company. Just give me one company. Give me one company that's doing anything of productive value. Just tell me. And he eventually told me Solana. Well, Solana was known as one of Sam's coins because he owned a lot of it. I think it was like $1 billion worth of it when they went kablooey. Did he really believe in Solana, or was he trying to pump his back? Like, what was that? Also, Solana has the unfortunate tendency to shut down. It just stops working. I think it stopped working at least a dozen times over the course of its history. So I found those answers very unsatisfying. You can't give me one company that's of any use in your industry? So there was those questions, and then there were questions about his donations. Probably the most nervous I think he got was when he wanted to talk about his effective altruism. He was going to give his money away, pandemic preparedness, all that stuff. I said, how much money have you given to that stuff? He said, 50 to 100 million. I said, okay. How much have you given to politicians? And he froze. And he turned in his seat and did all this stuff. And, he's kind of a twitchy guy, and I get that. He's got ADD. I'm not trying to. But, it was weird, and he wouldn't tell me. And at the time, I'm thinking, this is really strange because this information is public, right? We know he gave 40 million to Biden. We know his cohort gave 23 million to the Republicans. Why doesn't he just... And now, you know, what's alleged is that he was running a $93 million straw donor scheme. So maybe, I don't know, maybe that was why. It was a really bizarre interview. It was really one of the most strange hours of my life.
We've had our own weird interview with
Well, that's right.
Sam. Yes.
Well, that was very informative. So, I mean, if you don't mind, I'm just going to, you know, so in the spring of that year, he had been on your podcast with Matt Levine, and he talked about, I believe it was magic boxes out of which money comes.
The question was, how does yield farming work?
Right.
And we were expecting a technical answer of, you know, oh, there's this protocol
Greek
and
letters.
this protocol.
Yes. Instead, it was magic boxes out of which money comes. And Matt correctly said that sounds like a Ponzi scheme. I think Sam laughed. I don't know what happened after that. But it was really strange for me. I mean, you know, I got an ego and stuff, but I have an undergraduate degree. I'm an actor. I've just been looking at this for a couple years, and I'm here sitting talking to the supposed JP Morgan of crypto. Like, can he give me one satisfying answer? Can we get one, you know, moment where we could I could see how this was going to work? I left basically with a lot of questions, but they were all the same one. What the fuck was that all about? Like, what was that? It was really weird.
Yes. All of this sounds familiar. You mentioned law enforcement earlier. So again, let me ask the basic question, but where are the regulators? So we're starting to see some actions now, notably from the SEC, and the CFTC also sued Binance earlier this year. But where have they been? And why the reluctance to crack down on this industry?
Yeah. So I believe it was 2014 when the CFTC commissioner, Timothy Masad, asserted CFTC control over Bitcoin, said because there's futures were being traded, and under the CEA, the Commodity Exchange Act, 1936, they could argue that Bitcoin's a commodity. Okay, so that already creates a little bit of a gray area, right? Because if Bitcoin's a commodity, but these 20,000 other cryptos came into existence, what are they? You can say the SEC hasn't been as aggressive as it should have been, and I don't disagree with that. I think the politics are interesting. I mean, people are now very angry, Gary Gensler in the crypto industry, and they're angry that he allowed Coinbase to go public. Coinbase was listed on April 14th, 2021. Gary Gensler assumed office on April 17th of 2021. Say what you will about Gensler, but he does not have a time machine. So, look, here's what I'll say. Crypto has exploited a gray area between how we classify commodities and securities. I do think this is a problem. We are the only country in the world that separates our commodities regulation from our securities regulation in the way that we do. We have two different agencies. They are overseen by different committees in both the House and the Senate. That creates really bad incentives. As a armchair economist, that's very bad incentive-wise, right? Because people want to get on, politicians want to get on, elected members want to get on those committees to oversee the industries, but also to get donations, right? And the regulators are fighting for turf, sometimes friendly, sometimes not. The crypto industry really, really wants the CFTC to be in charge. The CFTC is the smaller agency. It's about a quarter of the budget, has about a quarter of the budget of the SEC. So there's a lot of blame to go around, I would say. But in the defense of regulators, it does take time to build cases to argue these things out in a court of law. So.
You know, we've talked a lot about the industry, but your story starts with like a friend. And obviously a lot of people have lost a ton of money over the last couple of years, particularly. Can you talk a little bit more in the course of your reporting, like sort of like the types of people that you met on just this sort of like the buyers, like the people who like got sucked in at the top?
It's everybody. I mean, it's really fascinating. Like you could interview, and I interviewed everyone from, kind of regular traders. I walked around the Bitcoin conference in Miami last year just talking to random people. And then, of course, there are more sophisticated players. There are hedge funds. There are, high-frequency trading firms, things like that. And then there are the sort of the core players, which, were Sam and CZ and, the folks that are kind of facilitating these transactions. so amongst the kind of the regular folks, again, I kind of go back to this point of like, crypto just becomes whatever you want it to become, right? It's like, it's a way of you expressing your, like, your freedom, your, you know, get off the shackles of TradFi and like find your own, create your own financial destiny kind of stuff. And I get that. That is such an intoxicating sales pitch. That's why Schiller talks about these narratives and how powerful they can be and how difficult they are to, he compares them to viruses. You know, it's sort of, you have to study the epidemiology of them, and we kind of have to, you know, reach herd immunity here, which I think we kind of are getting to now in crypto. But it's also very sad because I tell a story at the end of the book about a particular case. It's pretty rough. But you are also getting into gambling addiction. I mean, let's be honest. It's young men. 42% of men 18 to 29 have purchased, used, bought cryptocurrency. That's a big number. I mean, almost half. It's gamified, right? The apps are, it's very similar-ish to Robinhood, but unregulated. And it's easy to hide from friends and family. I mean, gambling addiction, we talked to some gambling experts for this, and they told us that it's a husband and wife. They run a boutique firm in Brooklyn, but that services a lot of Wall Street clients, and so they're treating all kinds of addictions. But they saw a trickle during the last craze of 2018, 2017, but they saw a tsunami recently. It's just, and it was all men under 40. Some of them are sophisticated Wall Street guys, sophisticated people that really know their stuff about all sorts of other financial stuff, but have gotten drawn in. And everything down to teenagers. I mean, parents coming in with their teenagers saying they're gambling away their minimum wage job, you know, their summer job paycheck on this stuff. And that's where it gets into the casino capitalism. That's why I want the book to be about more than just crypto. Because I do worry that we are, Keynes said this actually, you know, when I won't try to quote him exactly, but basically when you turn the nation's capital into its capital markets into a casino, you know, the job is likely to be ill done. You are not servicing an effective use of capital. And I believe we need to look at some of these things through the lens of how much social harm they can do. Gambling addiction, I've heard from several people, has the highest rate of suicide of all the addictions. It's much easier to hide because all you need is a phone and a few minutes or even seconds to make some trades. And so by the time families find out about the predicament that usually their son or husband, partner is in, it can be too late, and the money's gone. It is treatable. It is a very treatable addiction, but you have to take some pretty serious measures sometimes and remove the ability to make the trades and to actually access the accounts. So yeah, I'm not to turn it into a bummer, but like I really think we need to talk about these things because the marketing was, of course, the exact opposite. It was all the shiny stuff and all the amazing things. But when you come down to it, economically speaking, crypto's a zero-sum game. It's poker because it doesn't do anything productive. Yeah. It's strictly competitive. For someone to win, someone else has to lose. But it's not a fair game. You're not playing you're not playing in Vegas now. You're playing in Vegas in the 50s when the mafia ran it. You know what I mean? And unlike Vegas, where there's entertainment value, you can get comp some drinks, have a dinner, see a show. You know, crypto's like Vegas without the drinks, the dinner, or the show. So you're gonna lose. You know, you're gonna lose. 99% of people are gonna lose.
In the book, you actually talk quite a bit about the overlap between online poker and crypto, and you almost draw a connection between the end of online poker and the beginning of Bitcoin. Talk to us more about the overlap that you see there.
Sure. So in the original code that became the Bitcoin white paper code, there's a poker lobby. So whoever Satoshi Nakamoto was, whoever they are, we do know they were interested in poker. At the time, similar time to when the Bitcoin white paper came out, online poker was about to get crushed. It had moved overseas. All these online poker rooms had been set up, and eventually the government got around to shutting them down on what's become famous as Black Friday and online poker, and it was because they were cheating their customers. There's a company called Ultimate Bet that had a secret God mode where insiders could see the other players' cards. The compliance officer for the holding company, Escapsa, of Ultimate Bet, is a guy named Stuart Hoegner. He's now Tether's general counsel. Daniel Friedberg also. Daniel Friedberg also worked at Escapsa. He was FTX's lawyer. I think he then became their chief regulatory officer or something like that. Interesting.
Where were the signs?
Where were the signs? There are really strong parallels. So maybe maybe Bitcoin was set up to be this emancipatory new form of peer-to-peer currency, or maybe it was literally online gambling 2.0, a way of moving money overseas and using it to facilitate gambling.
One thing that you've talked about, and I think there's probably been other cases like this, but there's been a lot of peer pressure in crypto. It's like people telling their friend, it's like, you got to get into your friend, or just being told online, have fun staying poor. Yeah. If you don't. They
tried that line on me.
That line doesn't work.
Didn't quite work.
But that wasn't there in online poker like that degree, to which the sort of crowd whips its own members into a frenzy.
Yeah, and that's where I think you get into a multi-level marketing scheme. The abuse of language is similar. The way that they're sort of twisting words and trying to create a pressure-filled environment where you feel like, FOMO, you're going to miss out. If you don't invest now, really quick, you got to really quickly invest in the future of money, because otherwise you're not going to get in there, which is bizarre. But those tactics are very similar. And I would say, here's the thing that's a big tell to me. The use of the word community. The use of the word community is just fascinating. You're not an investor. You're not a client or a sucker. You're a member of a community. You're going to be reborn to the land of the free. Strange to characterize a financial relationship, especially with people you don't even know, right? I mean, so much of this stuff is done online and through pseudonymous accounts. That's your community? I'm not saying people don't find community. What's interesting is some of the strongest communities I've found are the participants in the class action lawsuits against companies that have allegedly defrauded them, because they're bound by the fact that they had a similar experience where they had a lot of high hopes and then they were let down.
It is true. No one talks about the community of T-bill investors.
Yeah, exactly.
It's not really a thing. Let me ask a devil's advocate question. But we've been talking about cryptocurrency mostly as a monolith. We did touch on the narrative flexibility around Bitcoin. So the idea that it can be many things to many people all at once. One of the things that it seems to be now, or at least there are some people pushing the story, is the anti-crypto. So if you lost money in, some random coin because of a centralized exchange that did something bad, you should buy Bitcoin because it's truly decentralized and only you have access to it in your cold storage wallet or whatever. How valid do you think that argument is?
So you're saying you need to be more pure. You need to believe more in the decentralization.
If you don't like crypto, you should buy the original crypto.
Exactly. Not a cult. I think, so that's the flippant answer. On one level, there is some truth in the sense that that Bitcoin is more decentralized by nature of the proof of work, but that cuts the other way too, because of course proof of work means it can't scale. Bitcoin can only process 5 to 7 transactions a second. It hits a limit. It hits what's called a red queen's race, where you're using more and more energy depending on how many competitors are there. The more competitors come in, the more energy is expended for the same block. So it's like what the queen says to Alice, right? You got to run twice as fast to get anywhere. It also, because of that energy usage, it has an environmental problem. I went to the biggest crypto mine in the country. It's outside of my hometown of Austin, Rockdale, Texas. It took over a former Alcoa aluminum smelting plant. And the reason it took that over is because it's connected to the grid, so it can handle a lot of power. In 2021, the Bitcoin network and other cryptocurrencies used the energy equivalent of Argentina, the entire country. That's a problem if you view it, as I do, as a zero-sum game. It's not doing anything productive, and yet you're using a lot of energy. So on one level, you could make the argument, oh, you're more pure, you're more decentralized. But in terms of stepping back for the rest of us, Why should at least not be taxed at an extraordinary level?
Real quickly, we just have a couple minutes left. You know, you mentioned, you used the virus analogy, and you talked about maybe reaching herd immunity. And then the question is, like, is there some pool of new money or new people that can be brought in to, like, keep it going? Like, do you think that, like, the sort of potential pool of would-be crypto buyers is more or less exhausted?
Well, it has utility, you know, for gambling. I mean, you can gamble on anything, so I don't think that makes it unique. But it has utility as a gambling device, and it has utility to facilitate crime, because you can use it for money laundering and avoiding capital controls, tax evasion, sanctions evasion, whatever. And I understand that there's an argument. It's like, well, some of that's good, right? We don't like some of these authoritarian governments. Okay, sure, but also, if it goes that way, it also has to go the other way, right? If the good guys can use it, the bad guys can use it. So, yeah, I just, yeah. I don't know how else to answer that question.
Actually, maybe a related question, but are you planning to write another book? What's next?
Well, I filmed a lot of these conversations, so I'm working on a documentary. And yeah, I don't know. I mean, I've had such a blast on this book. It's been such an adventure. I think the best part, I know it's a cliche, but it's really the people I've met, especially the skeptics. The skeptics are just a great group of eccentric, wonderful, you know, nerds. Like, it's just fun. And it's opened up my view of the world. I just have this much more, I just understand, I think, I'm not saying, I just have a much more varied experience in the world, right? Like, it's really been an adventure. So, yeah, I don't know what the next book is, but I really appreciate that everyone asked you that just as soon as your first book. That's not even out yet.
All right, Ben McKenzie, thank you so much for joining us. The book Easy Money, July 18th. That's coming out.
July 18th, thank you so much.
Congratulations, and thank you so much for coming on Odd Lots.
Please welcome to the stage Bloomberg Global Finance correspondent Sonali Basak.
Thank you all for joining us for the final day of Bloomberg Invest, the 3 full days. Thank you again to all of our speakers and our moderators for such a fantastic program. And thank you to our sponsors, our U.S. presenting sponsor, Invesco QQQ, our presenting sponsors, Allspring Global Investment, Neom, Principal Asset Management, and our participating sponsors, Southern Company and the Glenrothes Single Malt Scotch Whiskey, for making this event so possible. And if you'd like more information from our sponsors, please visit the resources tab on the event website and keep the conversations going on social. I know I certainly am. You can follow all our highlights at #BloombergInvest and at Bloomberg Live. We're excited to announce that Bloomberg Invest will return to New York on June 4th and 5th in 2024. I hope you'll join us. I'm already planning for it myself. This has been such a great event. And please join us now for networking reception outside these doors. Have a safe and pleasant evening. It has been so nice to work with you all.
Save me.